It does feel like equities are topping out a little bit.
There's a lot of dry powder out there for equities and for fixed income.
Even with wage growth as high as it is, inflation's still marginally higher.
Sure, inflation remains above trend, but it's really the growth story.
I don't think we're at the point where you're supposed to throw the recession call away.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
I've said it all week. You ask 5 different people what's going on with this bond market. They'll give you 5 different reasons. We need to find out the reason this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Your equity market slightly positive by 0.2%, but the main event is in fixed income. Treasury yields, Bramo, at new highs for 2023.
And the highest levels going back to 2009, and it's not just treasuries, it's around the globe. You're seeing this kind of push upward in yields. Is it because of inflation? Is it because there is a feeling that there aren't going to be as many buyers for this debt? Or is this just a wholesale freakout that is going to be reversed as people start to go in and capture some of this yield for a longer term?
What a pain trade in the bond market through the year so far. It hurts. In the FX market right now, this one might hurt as well. Dollar CNH, so let's have a look at the offshore yuan. Taking a move lower, so that's a stronger Chinese currency. Off the back of this headline, China told state banks to escalate yuan intervention this week. Lisa, what's that about?
Well, you saw the yuan fall to the lowest levels in 16 years. That was over the course of this week as you start to take a look at some of the economic data coming out that was a lot weaker than expected. The intervention has been subtle but growing. We heard overnight that the peg for the yuan was unusually below where it was supposed to be or where it was trading in the free market. At what point can China control the narrative through market manipulation?
Really strong fix overnight. Let's see if that actually makes a difference. We've been reporting here at Bloomberg, just on the housing side of things, house prices are much, much lower, according to private data providers and property agents, than China is leading us to believe. The official statistics say housing prices, new home prices, are down about 2.4% from the high back in August 2021. That's government figures. The private data shows something closer to 15% in prime neighborhoods in places like Shanghai.
This isn't new. Nobody ever trusts the Chinese official data, but it feels like there's something different about the tone of this distrust. That all of a sudden, not only is it just simply trying to cast a good pall over everything that's coming out of China, this is more. This is trying to craft a new narrative with data that does not reflect the reality that people are feeling on the ground. And I really do wonder domestically whether people are buying it, whether this is actually a message that really is resonating with anyone who could see the actuality on the ground.
Well, international markets aren't buying it. We know how many people are underweight based on how many people come on this program and say they're underweight and not touching it. Ben Laidler of eToro made the point this morning. It's an important one. It's an economic giant. It's a financial markets minnow. So what's the potential for contagion from some of the stress we're starting to see emerge over there?
The housing market is not a minnow. And we are seeing things that start to break there. And I will just say this, that one of the most interesting details in all of the stories I was reading about China overnight was this private wealth manager. You're actually starting to see protests percolate out with people coming out and saying, we want our money back. We don't understand. The fact that there are protests visible to the Western world is really notable in a country that really tries to discourage public unrest.
And we're seeing the GDP downgrades off the back of a lot of this. The goal for this year is something around 5%. That's the government's objectives. The view on the sales side, Morgan Stanley, they're down to a 4 handle, 4.7% for this year. They think China will miss their own targets. For the following year, they're looking for 4.2%. So it's not just this year getting downgraded, it's next year as well.
So glad that you said that. This isn't just about a GDP figure that comes in softer than expected now. It's about going forward. China is not going to be the engine of growth for this world. And it's unclear what the ramifications for that are and how negative or how much this economy can decelerate before you start to feel some sort of ripple effects.
China absolutely determined, together with the bond market, to bring Wall Street back from the beach. Let's get to the price action. Equities right now on the S&P 500. Positive by 0.2%. There is a lift here. There's a lift for yields as well. 430. Let's call it 430. 428.60 on a US 10-year. Yields higher by 3 or 4 basis points. New highs for the cycle potentially. Lisa, new highs for this year.
And it's something that people are wondering, how long can it continue, given that so many people have said, let's buy. Let's lock these yields in. Today, the retail sales very much in focus. Walmart coming out at 7 a.m. Ross stores after the bell. Tapestry about 15 minutes before Walmart. This is the sort of irony of the whole moment. We're talking about China dragging everyone down, this feeling of maybe inflation and people moving away from sovereign debt. And U.S. consumers keep spending because that's what they do. And that's what we're going to probably continue to see. 8:30 a.m., we see initial jobless claims come out. When do we actually start to see the jobless rate tick up? It has been moribund. It has been really steady around 3.5%. Do we need to see it tick up in order to see inflation come under control? And at 10 a.m., the Conference Board's leading economic index comes out. And I just want to point to the surprise index, the economic surprise index in the U.S. It has remained so high relative to history. In other words, the data is coming in above expectations more reliably than it has in a very long time. What does that mean about how much people are feeling negative about the U.S. economy and how that is not reflected in the data that we keep getting out?
Compare that to Europe.
Exactly.
A couple of months ago, turn it upside down.
Yep.
It's just ridiculous. We've got a lot of earnings. Walmart later. I just want to finish on Target just briefly. The Target CFO came out yesterday and he said something like student loan repayments would strain already strained consumer budgets going into year end. And as you mentioned, the White House has instituted this so-called on-ramp of 12 months. So is that really going to kick in straight away?
To me, this is one of the big mysteries. Everyone keeps looking at the student loan repayments as the boogeyman. It's going to come out and it's going to haunt all of the spending. And if you look at some of the studies, about half of all obligors say that they don't have the means to pay it, that they plan to default. About 1 in 5 have said in surveys that they
just
plan
straight up, we're going to default.
Straight up not pay. They have 12 months to not be penalized for just straight up not paying. Will this matter? It's a good question at a time when, people are saying it's on the peripheries anyway. It's not necessarily a central thesis.
Remember the conversation of last year? When are we going to burn out those pandemic savings? We both saw the same report from the San Francisco Fed. Have they made the call now? It's this quarter going into year end. It's this quarter.
Okay, this is crying wolf, though, right? And how many people are going to shrug this off and say, okay, you told us that last quarter, the quarter before, but now it's $190 billion and quickly going down. So we'll see. I don't know. Other people really disagree.
That's the question mark for Q3. Let's work through the price action then. Equities are up. Yields are higher. Joining us now is Linda Dussel, the Senior Equity Strategist of Federated Hermes. Linda, wonderful to get you with us on the program. Let's just start with China. As Ben Laidler said, economic giant, is it a financial market minnow that we don't need to worry about?
Well, good morning, and thanks for having me back again. Yes, it is the second largest economy in the world, and that the fact that it's the second largest economy in the world has implications for economies around the world, putting aside their stock market, which interestingly, and as you just suggested, lots of people thought we should run over to China earlier this year when they opened up after COVID. And now people that are invested over there are worried about that fact. And it just reminds us that the United States is a safe haven. And if it's more expensive than others, even Europe, I see, is trading below its 200-day moving average today. As we have our August correction and everybody is at the beach, this still probably remains the best place to find reasonably safe places to invest now.
If this continues, I'm not sure how much longer they'll be down at the beach, Linda, but we'll see over the next couple of days. Linda, you mentioned doubling down potentially then on the United States. Is that the way you see it? These events don't lead you to maybe pull back on risk and exposure in the US equity market. You think perhaps more and more people look to the US market as a haven?
Well, yes, I do, because and actually, if you look at the growth of economies around the world, manufacturing especially, much of the world now is moving in contraction zone or in contraction zone, and the United States is booming. So, when you talk about the student loan debt and the concerns for them, we calculate that as maybe 0.2% of the GDP of this country. When people say this country's economy is in bad shape, that I call hogwash to that. This economy is very strong. In fact, it's booming. Retail sales, whether you talk all in or exclusive of autos, are at record highs today. This is, I don't know how much longer we're going to call this revenge spend, but we have a very tight labor market. This is a great place to invest. It's not inexpensive, but there are certainly pockets of value out there that you can buy here in the United States as we work our way through, as we all know, is a traditionally seasonally more interesting, more difficult time in our market.
This all sounds really great, Linda. And then people take a look at the bond market and they say, maybe not, especially given the multiples that certain stocks are trading at. How do you understand the bond move that has left yields at the highest levels going back to 2008?
Well, I would agree with you where I think we're definitely in the camp that says what's going on here with these bond yields. And we wouldn't have thought that they would go up above 4% or up above it much. And I realize we opened today up around 4.3% on the 10-year. It really doesn't make sense if you think it has to do with an inflationary problem. I wonder if it has to do with the fact that markets are starting to realize that to get inflation below 3%, though, is going to be much tougher than you might think, particularly with the job market as tight as what it is. So yes, yields have been going up, and you may be losing money that way, but still, they probably should be at the high end. And I'd like to put a shout out now to what are the cheapest areas of this United States market, which sees earnings growing next year at 10%, and that is the high quality dividend trade. Nobody talks about it. If you want to worry about stocks because interest rates are going up, you could worry about growth stocks. Those are the ones that get hit when interest rates go up on the long end. They are fully valued, if you will. But the staples sector, the utility sector, the real estate sector, these are inexpensive sectors. Energy, very inexpensive, and they're not catching a bid so much late, so they don't seem timely, and therefore they're very good, a very good value, and they've got some yield for you as well.
I want to just build on what you were saying, where what the bond market is saying is that the Fed has more work to do to bring down inflation that is fueled by the growth that makes you positive about the equity market. At what point does this undermine the thesis if the Fed has to create real pain and the rates have to be more destructive to this economic growth in a way that eventually will hamper earnings?
Well, this is a very important consideration as we try to make sense of everything they said. And looking at the FOMC minutes came out yesterday, they really don't want to make the mistake of over tightening. So they may take a break here. We think that they're probably done raising interest rates for this cycle, and they want to watch and see, because they have certainly been very, very lucky with inflation coming down as much as it has this year. I think it's going to be some time. We will take some time. It might even be still a year from now when we wonder, do they really have to get to 2% before they call victory? We can live okay in a 3% inflation world, but they insist so much that we at Federated Hermes are taking their word for it. And that means that that's still hanging out there, that they could tighten us into a recession, but certainly not this year.
You don't see them tolerating a higher inflation number, Linda. People do. PIMCO is one of the firms I'm thinking of. They think maybe they start tolerating 2 point something on CPI. Does that not resonate with you?
Well, that makes common sense to me, but they keep insisting that they want it back down to the 2%, something in and around the 2%. Even if it's 3%, we were between 2 and 3% for 40 years. So they can get down in around that. It's just, as we know, it's that core PCE that they can't seem to get down enough. And, that goes to services, and that goes right back to the very extremely strong consumer. I think the word is resilient. I think that's a great word for what's going on in this country and with this consumer. And it's too early to call them dead.
The ingredients you've listed does not sound like a recipe to be long the equity market, Linda. Why is that?
Well, it would be long. It would be long the equity market if you said, inflation is coming down. We can live with this. The consumer still has the wherewithal, and I have to laugh too when they talk about all this excess savings is going to be gone within a quarter, and that's excess savings over 2019, in which we were doing just fine before COVID hit. So the consumer is strong. Unemployment is reasonably good. Inflation is slowly coming down. If 2% is not a magic number, and so if it continues to come down and corporations can see that they can push through price increases and their earnings look good, and consumers are seeing their real income up. I saw a statistic just yesterday that said if you looked at the price changes, all the prices that we have to endure this year versus last year, but with our real disposable income, we have 8% more this year than we did last year. That's because our real income is higher this year.
Linda,
we didn't get a pay cut.
I got to run. We could do this forever. Linda Dussel of Federated Hermes. Linda, thank you. Your bond market yields 4.30 on a 10-year. Equities just a little bit higher. Coming up a little bit later, Troy Gajewski of FS Investments, live from New York. Good morning.
China made a set of different decisions, and because of that, I would agree that China does present a headwind, not just to the U.S. economy, but to the global economy. But we're better prepared to deal with that than any other economy in the world because of the policy choices we made here in America that are allowing our economy to grow, us to create jobs while inflation is coming down.
That was Wally Adeyemo there, the US Deputy Treasury Secretary, catching up with the team here on Bloomberg TV and Bloomberg Radio. Bit of breaking news in the last 10 or 15 minutes, so allow me to share some of that with you. This is our reporting here at Bloomberg that according to people familiar with the matter, Chinese authorities have told state-owned banks to step up intervention in the currency market this week in a push to prevent a surge in volatility in the yuan. Lisa, dollar CNH turning around a little bit here off the back of this. So this currency pair is negative a third of 1%. That's a stronger Chinese currency.
And it comes after the Chinese official government came out with saying they wanted to possibly ban selling more shares of stocks than buying. The manipulation of the message coming out and percolating into the markets more and more as they try to grapple with an economy that's underwhelming some expectations.
Is it sufficient? And I would say, is there a misplaced comfort here stateside in US markets? Linda Dussel was talking about the comfort there. Another reason to double down and reinforce this view of US exceptionalism. I think backed up, supported by the economic data we've had so far. But I remember plenty of times in the last 10 years where we had a little bit of a sniff, a cold, a flu over in China, and there were big problems abroad.
Even if it's not market-based, it's economically. The interconnectedness of these two economies, everyone agrees, is much greater than many people would like, but also than many people really realize. So at what point does it have to factor into expectations at a time when people are banking on American exceptionalism in still an interconnected world? We're not actually in isolationism.
I probably shouldn't use sniff, cold, flu as an example of Chinese markets and stuff like that, because clearly I'm not talking about what happened 2-3 years ago. I'm talking about some of the issues back in 2015, 2016. Was it August 2015? We had the currency difficulties.
Yeah.
It's that long ago, 8 years ago.
And we're still going through some of those levels, just to give you a sense. So this is the problem that we're facing right now, is we're looking at these kinds of markets. Is it a free market? Is it an accurate reflection of where people are? No one thinks it's a free market. And the same thing as what we're seeing over in Japan. But here, it's unclear exactly what the ramifications will be.
Let's get the conversation started on China. We can do that with Susan Thornton from Yale University Law School. Susan, wonderful to have you with us on the program. I think we've always given the Chinese policymaker the benefit of doubt that they can resolve these issues in an orderly way. Is there any reason to believe it is different this time?
Well, I think there are a couple of things going on here. One is they're running into structural economic problems, right? We've seen them trying to reform over the years, and they've obviously run into a lot of difficulty with that. And then you see the lack of confidence and the faltering in trust in the economic officials and the Chinese leadership after the COVID lockdowns and then the unwinding of COVID in China. And so I think we're really looking at a kind of a loss of confidence on the part of both Chinese participants in the Chinese economy and also foreign participants.
We heard from the State Council today. They promised to meet annual economic targets through, quote, targeted and forceful macroeconomic adjustments. Susan, what does that actually mean? What levers do they have to restore confidence, as you say, that's been absolutely hammered over the last few years?
Yeah, well, they've been struggling to try to find policy responses that are going to actually bring about what they need, which is they need households to start spending. And this has been a problem in the Chinese economy going way back. They've got the highest level of sort of savings in China, and they can't seem to unlock that from households. And so I think what we've seen is they've tried to kind of lower interest rates. They've tried to push out, tiny bits of stimulus, but they're loath to kind of push out a lot of stimulus because they've got a problem in the housing sector, in the real estate sector. And so I think they're really limited. I think what they probably need to do is to try to give some confidence back to the private sector, which is really sitting on the sidelines at this point, looking to see what's going to happen and lost confidence.
Part of this is international as well, because there was a lot of international investment from U.S., from European companies. We've seen an increasing number of U.S. companies pull back just a bit or significantly. How much do the Chinese authorities want to see some of those international businesses come back versus embrace the isolation, the sort of domestic focus that seems to be more front and center?
Yeah, I think you really see them trying to do everything they can to encourage foreign businesses and foreign direct investment to come back into China. It's been a tough 5 years for foreign businesses trying to work in China. I mean, not just COVID, but all of this slew of regulations that have come out, a lot of kind of chilling rules and laws that have been passed, especially on cross-border data flows. It's been very hard for companies to deal with trying to get, the data that they depend on to do their businesses in many cases back and forth across the border. And so there's just been a whole slew of problems that have kept people kind of wondering what they should be doing about their China business and how they should be looking at this market long term.
With all your years' experience as a diplomat for the U.S. to a host of Asian nations, I'm wondering if the economic difficulties that China is facing makes it more or less difficult for the U.S. to negotiate. In other words, does the U.S. have more leverage or less leverage as a result?
Well, I think what I've seen since the Chinese have really started to face up to the fact that the economy is not going to bounce back after COVID the way they were talking about initially. There's really been a big change in, I think, sort of mindset about the need to maintain connectedness with the rest of the world economy. And I think there was a question about that at one point earlier. And there may still be a division inside the Chinese leadership on this, but certainly the technocrat economic experts in the Chinese government understand that the Chinese economy needs to maintain those connections.
Susan, last week, the president of the United States referred to the Chinese economy as a ticking time bomb. He referred to some government officials as bad folks. And he said, when bad things start to happen, bad folks do bad things. Susan, what do you reckon he meant by that just last week?
Well, it's very hard for me to get inside the head of leaders when they say things, Xi Jinping or Joe Biden. But my sense is that what he means is that the Chinese economy is not as impregnable as we've been thinking, that there could be real risks here, and that, the Chinese economy is really important to the sort of stability and psychology and internal kind of predictability of the Chinese state and the Chinese leadership. And so I think what he meant is that, if the Chinese economy isn't going to be doing well, then the whole Chinese government is going to be getting more desperate, and we may see things that we, might not otherwise see. And I think he's worried about some kind of incident or accident that might cause some kind of conflict or crisis that we wouldn't normally see if the Chinese were more confident than they are now.
Susan, I have a feeling we'll be talking again soon. Susan's thoughts in there of Yale University Law School. There is a hope, I think, that this can be dealt with in an orderly way. Lisa, for obvious reasons, given what the president said in the last week.
And especially given the fact that the market is not necessarily completely independent from the rest of the world, considering it's the world's second biggest economy. I just keep going back to the fact that we did see about 24 protesters outside of the offices of this private wealth manager. This is unusual. This shows that it's not just going over well with all of the locals who are watching some of these problems.
Not totally unheard of, but it does speak to some of the social unrest that you're discussing, you're mentioning, together with the youth unemployment figure that isn't going to get published anymore. I don't want to labour that point too much, but I think it's important. It is obvious there are some concerns around that issue right now, which is why some people believe that's why we're not getting access to that data point.
From a market's perspective, how do you game out Chinese buyers of luxury goods internationally? How do you game out Chinese buyers of international properties? How do you game out some of the market implications at a time when there is a lot of opacity? But these have been major players in a lot of the markets around the world that have been inflated also by low rate policies. These are some of the nodes of contagion that I'm trying to understand.
The nodes of contagion from
know.
China to the rest of the world. It's not in the treasury market, is it, right now? There's no rally. That traditional haven bid you might expect, not developing. We'll talk more about the bond market with yields and new highs for 2023. We'll do that with Dominic Constant of Mizuho from New York City. This is Bloomberg. Two-day losing streak on the S&P 500, attempting to avoid making that number 3. Your equity market right now on the S&P, slightly positive, futures higher by 0.2%, the Nasdaq higher by 0.24%, heading potentially for a third week of losses in the equity market. On the S&P, that would equal the longest weekly losing streak of the year so far. In the bond market, 2-year, 10-year, 30-year, you know the story the last 24 hours, yields up up and away. 4.30 this morning, 429.99 on a US 10-year yield higher by 5 basis points. For those of you interested, through 4.30 in the last 24 hours. And Lisa, potentially very close to a new intraday high for this cycle as well.
I want to understand when the bond bulls start throwing in the towel. We have not seen it at all yet. And I wonder how much they're buying, given the fact that we keep seeing yields move up higher and people keep scratching their heads and giving 5 different answers to exactly why. But if they are so convicted, why wouldn't now be a screaming buy? And why wouldn't you see that at all in the markets?
This is day 6 of yields higher. Day 6. I believe yesterday was 12th consecutive sessions of yields closing above 4% on a 10-year. When we asked the question, can we sustain life above 4%? It appears over the last 2 weeks we can.
The problem is, this isn't just inflation expectations. If anything, longer-term inflation expectations have been coming in. This is the real yield when you strip out inflation expectations, which has surged to the highest levels going back to the financial crisis. How much are we looking at people taking a look at the fiscal package of the U.S. and saying, I don't know about that, and taking a step back in a way that people said they wouldn't do just a couple weeks ago?
Let's turn to the FX market. Take a look at 3 currency pairs. I'll touch on the euro, which has been a bit of a snooze more recently, in and around 109. 110, then a breakdown of that level to 108.82 with just about unchanged. I want to go to dollar yen, 146. We went through the levels yesterday, Lisa, which triggered the intervention in the last 12 months. No sign of intervention just yet on that currency pair. I'll talk about that third currency pair, dollar China, in just a moment, but the BOJ is off the radar because treasuries in China are very much on the radar, but there are reasons to be following what happens next to the BOJ.
Although what I've been interested in is the growing number of reports where people say maybe they'll wait. Maybe they won't necessarily intervene as quickly as they did last time around, just because the weaker yen actually helps them with exports and it helps with inflation, and they actually want to see more of that. So yay. I mean, honestly, there's sort of a counterintuitive discussion there. But either way, how do you trade this thing? How do you have conviction to go against a whale?
Tough. Inflation data out of Japan coming up tomorrow. Under surveillance this morning, minutes of the Fed's July meeting showing officials are still worried about bringing down inflation, and further rate hikes could well be needed. But there are some cracks in the consensus, and they're becoming more and more apparent, with 2 officials favouring leaving rates unchanged. So the committee increasingly divided, Lisa, going into Chairman Powell and Jackson Hole next week.
So when I read these minutes, I was left with a shrug. I had no idea what we learned new, except that clearly they are concerned and they're saying they're making noise about inflation, but there's no conviction. What I thought was really interesting is they said that they were willing to keep allowing the balance sheet to roll off, even if they have to cut rates or when they have to cut rates. So it seems to game out, yes, they're going to cut rates, but there still will be a quantitative tightening with respect to the balance sheet. I don't really feel a cohesive theory here. Relatively speaking, the committee's all over the place. The way to gauge the shifting direction of the committee is just a very simple question. The balance of risk between under-tightening or over-tightening. It was very clear what their view on that was last year. It's coming into balance, clearly, and you see that in the minutes with this quote. It was important that the committee's decisions balance the risk of an inadvertent over-tightening of policy against the cost of an insufficient tightening. When you're at that point, you move more slowly, which is arguably what they're starting to do. Are they concerned about long-end yields rising? Is the message from that something that indicates maybe they're being a little too sanguine about the inflation risks and that they're not raising rates? In other words, if they are more hawkish, will that actually bring longer-term yields in because people stop banking on this idea that inflation is going to run well above the 2% target? Is Chairman Powell confirmed yet for next week? I haven't seen that confirmation. You're still going to go with this? No, I believe. Chair Powell, I understand he's very likely. Public service announcement. I believe he's very likely to speak next week. If you would like to clarify some belief in certain corners of Wall Street, you may not speak. It would be nice to have it confirmed. Just give us a call. No, I understand that he probably is going to speak. I'm just waiting for confirmation of that and maybe get a sneak peek at a speech. That would be nice as well, but I doubt we're going to get that. A preview interview? Something like that. That's not going to happen. Let's turn to China. Ramping up efforts to stem losses in the currency. Authorities telling state-owned banks, according to our reporting, to step up intervention in the FX market in a push to ease volatility in the yuan. Responding to that story, Lisa, we have a Chinese currency that is stronger in the last 30 minutes. Why push against what the central bank is trying to say to do? How much can they manipulate a market to give a different impression than what everybody keeps saying is a weakening economy and weakening more than expected? We saw housing prices drop more than expected, less than probably is actually happening on the ground. We got that overnight. At a certain point, They can't change the narrative with market manipulation when everyone knows what they're doing. And that, I think, is sort of one of the big takeaways for me anyway.
Let's finish on an important story. We're following developments of this over the last couple of weeks. Maui officials defending their decision not to use public sirens to warn Lahaina residents about last week's wildfires. The head of Maui's emergency management saying sirens could have sent some people fleeing straight into the path of the flames. Lisa, there's still a lot of questions about the response to this.
Reading about this story is so heartbreaking, and seeing the images that it's difficult. The idea of what do you warn residents about is really going to be a growing question. It was tsunamis for a long time. These sirens were placed around the border of the island. Do the sirens have to change? Do the alert systems have to change as the risks increasingly grow in different ways in different regions?
Any more developments on that story? We'll do our best to bring them to you. Joining us now is Dominic Constant, the head of macro strategy over at Mizuho. Dom, we have to start with the bond market, and thanks for being with us, buddy, as always. What's behind this one from your perspective? Yields up and away at the long end.
Well, this sell-off is obviously very different from the sell-off that we had in the aftermath of the bank crisis. This sell-off has been led by the long end, the back end, the 10-year yield, the 30-year yield. It's also been led very strongly by real interest rates rising. And it's not being led by, for example, the front end repricing with the Fed over the next year. So what that means is the bond market is adding a lot of risk premium to it. So the risk that at some point, maybe in a sort of the 1 year, 2 year sort of point in the future, the Fed will have to perhaps resume tightening. But it also reflects some of these supply concerns around the deficit projections and also QT, the very fact that the Fed is continuing to do this massive rundown on the balance sheet that really affects the demand-supply balance at the long end.
Do you think that it's fair, Dominic, to actually give any narrative to this? Or do you think that there is something technical going on with some selling from the bank? Some people are talking about new trading methodologies. Do you buy any of that? Or do you think that this is something actual and reflective of a belief that's percolating through markets?
Well, it's been the case for a while now that the sellers of treasuries have been basically banks, foreigners, and obviously the Fed. And the people who need to buy treasuries are the domestic sort of household sector, including sort of real money managers, etc. And the trouble is that that's easy enough to do for the front end. If there are lots of T-bills around offering healthy interest rates well above 5%, I think it's quite easy for that transition to take place. I think the problem is that when the Treasury comes out and says we want to issue more longer dated debt, then that creates a bit of a problem. So I think sort of technically speaking, yes, there may be some sort of technical sort of programs that are affecting our market in terms of liquidity. It is summer as well. But fundamentally, there needs to be this transition whereby we need to domesticate our market and focus it on the household sector. And because the Fed is selling and banks are not buying, basically. So that's just an unwind of the sort of grand QE programs of the past.
If that's the case, how much further does it have to go?
Well, if you look at all the models and stuff, and you look at what we call term premium, which is risk premium in the back end, it is too low. It has been too low for a while, reflecting this overhang of the Treasury balance sheets. Basically, a one standard deviation sort of add-on is about 20 or 30 basis points. So I would reckon we're crossing into the sort of slightly cheap area now. So that means you could get 10s up to around 450, 460 as a sort of term premium trade. I think it should be done in real rates. That would make sense, but you have to be very careful because this undermines risk assets. This is very insidious in a way that the bear flattening driven by a Fed hiking rates, having to get rates up quickly. Believe it or not, that was much less insidious for risk assets. This is much more a problem for risk assets. So ironically, something similar like this happened in 2007, 2008, where term premium was quite low. It finally started to break higher. It was led by real rates. All that risk premium has to be competed for by equity markets, and equities, unfortunately, sort of are repriced lower. And ironically, that may be exactly what the Fed needs to actually break the labor market. They're the ones who want to break this labor market and getting the equity market down and getting CEOs worried about earnings again and having to cut costs. Maybe that's finally what gets us into a proper landing, if you like. And this just makes harder landing risks even harder, ironically. And it's all about timing that.
Well, Dom, there are plenty of questions out there there right now about the durability of a bear steepener, the ability to sustain levels like these for much longer, because sell-offs like these can be self-limiting, precisely because of what you said, that ultimately they start to cause pain and the buying comes back. Would you push back against that view?
Well, only if we're kind of wrong on the macro, if you like. So if really inflation is a sort of a problem, and inflation is going to go back up again, and maybe the consumer is reaccelerating because they suddenly found more money, and there's a wage price spiral, that would be the only problem. I would say the macro side of things actually looks in place. There's a reason why the Fed is in transition. We discussed the minutes and everything. The Fed is in transition. It's less clear on the macro side. Do they need to keep pushing up short rates? Inflation seems to be sort of beaten for now, etc. So as long as that's the case, and in the labour market there is signs of labour hoarding and slowdown in labour demand in terms of vacancies and aggregate hours. So I don't think that's really changed. It's really this sort of risk premium story in the back end of the market. And if that is going to bring down the equity market, then I see no reason to push back on it. There's a limit to how far you can sell off. Tens, 450, 460, as I said, probably looks very good value. And I would think people will start coming in to buy front end rates, especially if real rates continue to rise at the front end. 5-year real rates are pretty chunky at the moment. And if they go up another 20, 30 basis points, that's going to be quite attractive, I imagine, to a lot of investors.
Dom, this was a clinic. We've got some time to squeeze this one in. We're reporting this morning in the last hour that Chinese authorities have told state-owned banks to step up intervention into the currency. Can you run us through how that would happen? What would they be selling to strengthen the Chinese currency?
Well, I mean, they'd obviously have to be selling sort of some kind of, dollar holdings that they have. And, there's plenty of those, we know. And that would sort of, feed through, indirectly, obviously, into the renminbi. I mean, my guess is in the end, it's really about more verbal intervention than actually sort of selling a lot of dollar assets that they have. I mean, how many treasuries they have in some of those state banks. I wouldn't think that they're the first things that they'd want to sell if things are sort of going badly at these levels, at least.
You're joining the dots for me because you know what the next question is. I'm just wondering if any of this stuff in the treasury market is somehow connected.
I mean, it's possible. There are a lot of these little things, like YCC in Japan was another thing. I mean, people concerned that the Japanese, are going to, the YCC tweak and repatriation flows. I mean, these are all reasonable sort of concerns. But the optics of it, to be honest, I mean, Japanese investors in that example, they haven't been big buyers of treasuries, so it's not obvious they're suddenly turning on their heels. I think you just start from something that was very obvious to everyone, was that the long end was being held down, artificially held down by people being very complacent about the supply issues in the States and this ongoing QT. And summer months are illiquid, and that's kind of what's hit you. I think really we don't get a sense that there's a massive selling by foreign players or treasuries that's driving the market. It's not really that. It is just a sort of appropriate repricing, if you like, of some of the risks out there. Yeah. And as I say, it's could be just be a bit of a blow off top for another sort of 25 and 40 basis points or so, and then things will settle down. Got
a big wake up call from the Treasury just a couple of weeks ago. Dominic, thank you. Dom Constant there of Mizuho on this Treasury market. High of the session on a 10-year. 130.98, just south of it right now. High of the cycle intraday, 433.54, getting closer and closer. Coming up a little bit later, coming up next, Dan Ives of Wedbush on Apple, on whether this tech bull is still bullish in the face of what's developing in fixed income. Live from New York, good morning.
Google, Facebook, Alibaba, Amazon, they want eyeballs. Apple, they want eyeballs on their sites. So they're now a player for programming. The one thing they're missing is content, and that has exploded sports valuations because sports is must-see TV, live TV. I think it's going to be a messy transition from the old to the new, and the traditional networks, fighting with the internet networks.
Steve Paliuca, co-chairman of Bain Capital, speaking with Bloomberg's Ed Ludlow at this year's Sun Valley conference back in July. It's amazing how undervalued I would say some of these clubs actually are. We're talking about valuations of 5, 6, 7 billion US dollars on institutions that have massive recognition, brand recognition worldwide. I'm thinking, say, a Manchester United. And the more you get into some of these football clubs, you start figuring it out. They're really badly run, really, really poorly run. And I think guys like people from Bain, Steve Pagliuca, others that have taken an interest in football clubs, figured that out and can work out pretty quickly how they can extend brand value and fast.
And then who's next to come in, right? Is it Saudi Arabia who wants to come into the tier 2 types of leagues? Or is this going to be something where suddenly the content providers plow in, try to lock it up, try to make sure that they can capitalize on it, because it is going to drive a lot of engagement, whether it's a Netflix series or whether it's something, just in terms of streaming the games.
Well, he's running it for business purposes. He's got an involvement in an Italian club in the north of Italy, Atalanta. The Saudis aren't. They're doing that for soft power. That's when there's a wrinkle here. When you have two sets of actors, some people are driven by market forces and they're price sensitive. And when you've got someone in the market who's totally price insensitive, rather like central banks in the bond market in the previous 10 years, we could talk about that another time. They're the Saudis right now. They're in this market. They're buying football players. They're totally price insensitive. Does not matter at all.
Which is the reason why anyone else who's looking to buy is looking at the tier below, and that's going to get really interesting, right? Or the 2 tiers below, to see how they can try to delve in and compete with the Saudi Arabias of the world.
Brady and Birmingham City,
yeah, exactly,
got their first win over the weekend. He was there. He was at the stadium.
Yeah, I'm just excited for all the Netflix series, so I can get more into it.
That hasn't been confirmed though, right?
I'm just basically spreading rumors.
Okay.
Maybe Jay Powell.
Good rumour. Lionel Messi's early success over at Inter Miami, drawing plenty of attention to Apple TV's MLS broadcast. Dan Ives of Wedbush saying the tech giant could now be a player for Disney's ESPN. He writes this: ESPN as an acquisition or strategic partnership to Apple is a no-brainer. It potentially could be on the table depending on the Disney strategic overview and ultimately where Iger and the board land on the asset. Dan Ives, Senior Equity Research Analyst over at Wedbush, jumping on the phone to talk to us about this. Dan, always great to catch up with you, sir. Let's start there. Are these just rumours that you're starting over at Wedbush, Dan, or do you have real reason to believe this asset is, one, up for sale, and two, Apple would be an interested buyer?
Yeah, I mean, in our opinion, it's a matter of when, not if. I mean, I looked at Apple in terms of what they're looking at for sports content. It's the perfect marriage. And right now, the strategic review at Disney, I think it was clear even from the conference call. I mean, ESPN, I believe, is something that could be on the block, and Apple is the natural fit for live sports content. That's the golden goose. At a minimum, it could be a strategic partnership. We believe this is the start of what could really be a very strong partnership at a minimum between Apple and Disney.
Dan, the next logical question, price. What would the price be?
From an M&A, and of course, Apple historically has not done big M&A, 50 to 60 billion would probably be the initial price tag, in that range. I mean, when you think about it, that's, for a company that has 200 billion in cash and generates another 150 billion, that's extremely affordable, right? And it's really about the asset, because I think MLS has been the eye-opener for Apple. Pac-12, they tried to do that deal, it fell apart. I really, truly believe Cupertino recognizes this is the window. This is the asset. I view it as the golden asset, and I think it would add massively to the sum of the parts if they did this.
Dan, at what point does there become another bubble in content? And I'm talking about sports content. If you have the behemoths in the tech industry seeing incredible value and bidding this up.
Look, Lisa, it's a scarcity value, and I think that's the issue right now. Just a lack of core assets. And who's going to get in? It's Apple. It's Amazon. It's potentially Netflix. I think Facebook and others. You're going to see more and more tech going after some of these assets, because that's really the scarcity. And I think that's really what's going to drive eyeballs, which is why I think for Apple, the clock struck midnight. They recognize now's the time to do this. And now it comes down to, Iger, Cook, and ultimately what happens with the Disney strategic review.
Dan, I gotta point out that right now, the background noise that we hear, I imagine, is some bustling, beautiful town in Crete, an area where you're basically doing a victory lap after getting the tech trade completely correct. I'm just wondering, from your vantage point, going forward, how much longer you can see this rally really get confirmed at a time when people are really shrugging their shoulders about it at this moment, given where yields are?
Yeah, I mean, in my opinion, it's a near-term pause before a tech rally that resumes into year-end. I think the growth going into 2024 continues to be our focus. AI, I view, is the biggest transformational tech trend we've seen in 30 years, and we continue to be macro-aware, micro-obsessed. I think we're in the start of a new tech bull market. We've handheld our investors through this. This is not the time to pause, in our opinion, relative to tech. I think it's halftime of the Super Bowl.
I wouldn't have disclosed your vacation destination, Dan, but Bramo's brutal. I apologise for that. I'm distracted here, Dan. I've got to go to the bond market, a 30-year at 4.42. This is a big move here, Dan. We're talking about highs we haven't seen going back to 2011. Dan, is that a challenge to your bullish thesis for tech stocks?
Yeah, I think there's no doubt with the 10-year, and we saw it last year, as you and the team covered so well, and that is a headwind, but I believe it's a near-term headwind. There's like our view going into next year, despite tough talk, Fed's going to have to cut. The risk-on trade's there, and I view this as just a temporary white-knuckle period, back maybe sort of Groundhog Day to a year ago. I don't view this continuing over the coming months, and that's our view. I don't view this as a repeat to a year ago.
I imagine you hope it doesn't continue as well. Dan, thank you, sir. Enjoy the break. Dan Ives of Wedbush jumping on the phone to talk us through that call he made recently in the last 24 hours.
I was
from his
not
vacation.
being brutal. I was not
brutal,
being brutal.
Bramo. It's
How
because
is it
TK
brutal?
did it to you and Norway and the fjords.
Which I wasn't.
You want to talk about this bond market? 30-year
Yes.
yield, high since 2011.
And we can see that the 10-year yield, the highest since 2008, driven by real yields at a time when people are wondering how long it can last. Dominic Constam saying that we could get to 4.5% to 4.6% on the 10-year before it starts to calm down, settle down. I don't know. This feels different given the grinding nature of it, that it isn't some sort of sudden sell-off. It has been persistent and something that people are really reflecting on in a broader way.
You know what's different about this to me? It's not well understood. There seems to be a lot of confusion about why we're up here. If you ask people why yields were higher 12 months ago, they'll all give you the same reason. That's not where we're at right now. There's real disagreement about whether it was supply, whether it is yield curve confusion, whether it is developments elsewhere. I don't think anyone really believes it was the downgrade, whether it's off the back of the stronger data we've seen in America. And depending on what you think it is, that's going to shape your opinion on where you think risk assets should be. If it's off the back of better data, then maybe you've got a more constructive view on certain parts of the equity market and credit. If it's off the back of supply, then arguably that's going to be a bad story for valuations elsewhere. I think there's a real confusion about this bond market move, and I've noticed that over the last 2 weeks, and I know you have too.
Part of it also stems from it's unclear how much is really tied to Fed policy, other than if they stay on hold, you could see some of the more persistent inflation, persistent growth, and persistent concerns about a deficit that isn't coming down in the U.S. That, to me, sort of underpins this. We heard that from Dominic Constam. This is coming from real yields. It is not coming from what people are expecting for inflation or Fed funds.
We've likely got it the wrong way round as well when we think about China. China, the tail wagging the dog and wondering why it's not shaking up US markets. US markets, yields up, real rates higher, dollar stronger, putting on the squeeze on the Chinese currency at a time where it's finding a lot of difficulty in the economy, exacerbating existing underlying fragility in both China and I would say Japan as well, with the move we've seen on dollar yen in the last day or so.
I wonder how much this is a market squeeze versus an economic squeeze. There was a story overnight talking about Tyson, the meat processor in the United States, looking to sell their Chinese business. And we see this increasingly. Apple looking to move more of its production to India. De-risking. We have seen this so consistently, and it's quiet because no company, no executive wants to come out and say publicly, we're moving away from China, because if they're not fully out of China, they will be penalized by China in the process. So we're not hearing about it on calls. But that's what's happening under the hood. How much is that part of this whole story that's a much bigger driver than people fully appreciate?
Tim Cook, the ultimate diplomat,
yes,
has been. It's phenomenal the way he navigates some of these issues. How he navigated the Trump administration was pretty artful. You'd have to say, oh, it was phenomenal, absolutely phenomenal. Troy Gajewski of FS Investments coming up shortly. Your equity market just about positive on the S&P 500. Bond yields at new highs for the cycle at the long end.
It does feel like equities are topping out a little bit.
There's a lot of dry powder out there for equities and for fixed income.
Even with wage growth as high as it is, inflation's still marginally higher.
Sure, inflation remains above trend, but it's really the growth story.
I don't think we're at the point where you're supposed to throw the recession call away.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
We are shaking up this bond market live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance live on TV and radio alongside Lisa Abramowicz. I'm Jonathan Ferro. The numbers you need to know: the 10-year yield, new high for the year; the 30-year yield, new high for the decade. Lisa, cycle highs on a 30-year this morning.
And you really put it well. The why of it is sort of a mystery. Or you can ask people, and people explain it in different ways depending on who you ask, and that will determine whether they think it sticks or not. What the read-through to risk assets, though, is really interesting. We were speaking with Linda Dussel earlier in the show, and she was confirming her conviction that there was going to be strength in the equity market, even with higher yields. How long can that actually last, given the nature of this rise?
It's getting increasingly difficult to find consensus on the FOMC. Where there is consensus based on the recent minutes, most participants continue to see significant upside risk to inflation, which could require further tightening of monetary policy. Everything that came out yesterday, the Fed minutes, the economic data, just continue to provide fuel to this bond market sell-off.
That's true, and we're going to hear more from Jackson Hole next week. At a certain point, though, you have to wonder whether it's self-fulfilling, whether basically, to Dominic Constam's point, it has a self-limiting factor that causes buyers to come in, especially given all of the big bond houses that have come out and said that they see this as a buying opportunity to lock in yields. Where are those convictions right now? Where is the mass buying in this newly domestic market, as Dom was saying?
Walmart numbers just dropped. It's a beat and it's a raise. The numbers look like this. Adjusted EPS for the second quarter, 184. The estimate, 170. Revenue, better than expected, and the outlook gets a lift as well. The new range for EPS for the full year, 636 to 646. They had previously seen, Lisa, 610 to 620.
And we will parse through this to understand exactly what degree of this is from the grocery side of things, from the staples versus discretionary. Looking at ex-gas, the sales were up 6.3% versus the estimate of 4%. So same store sales, very much an increase. Again, just confirming this fact that people do have money to spend, despite the fact that it was supposed to run out by now. And the idea that we're going to go forward with a U.S. consumer that can diverge from at least the worries around China.
It was meant to run out 6 months ago.
I know.
Maybe even 9 months ago.
I know. And now it's going to run out this quarter.
Walmart right now up by 2.7% in the pre-market. Broader price action shaping up as follows on the S&P 500. Futures positive by 0.15%. And there's the move in yields. Lisa, the 10-year yield higher by 5 or 6 basis points. We are higher here once again. We're at 430.58.
Is this what's going to do the trick to actually bring the U.S. economy into check when it comes to inflation, when it comes to consumer spending? Is it going to actually crack the labor market? And that's the reason why people are so interested in retail sales. We did just get Walmart. Those shares popping, as John was saying, a beat and a raise. And we can see that in the share prices across the board. Very strong. If you look at what we saw just moments ago from Tapestry, not so great. They missed their forecast going forward. Those shares lower by about 1%. Ross Stores report after the bell, giving a sense to what we're looking for. We're also going to look at consumer confidence expectations, which come out around 10 a.m., the leading indicators, at a time where economic data has surprised us to the upside again and again. At what point can this continue, given where longer-term rates are? Will this have the restrictive feel that many people are expecting? And then later on today, we're expecting to see a little bit more out of the Federal Reserve. We've been hearing from them consistently, and we're going to get a bit more of a sense of that at a time with initial jobless claims coming out at 8:30.
6 days, Treasuries have sold off, and yields are higher over that period by almost 30 basis points. Troy joined us now. Troy Gajewski, Chief Market Strategist over at FS Investments. Troy, the question of the moment, what's behind the bond market move, Troy?
Yeah, great question. Look, when you step back and you think about the path of how economic forecasts and market price action have evolved, I think if you go back to remember last November, almost every bond market participant, right, was calling for an imminent recession, which helped justify, an incredibly inverted yield curve, right? 2s, 10s got over 100 basis points inverted, only been more inverted in, the Volcker era in the late 70s. And that persisted for a while. However, clearly, as economic data has come in stronger and stronger, that's caused a major rethink of that thesis. And even though inflation has come down, you've had the curve flatten out and the back end, come up significantly. And this has been one of the reasons why yield curve steepeners have been one of our favorite expressions, because there's two ways you can win, right? Either we have a fast recession and the Fed has to cut, or in the event that the economy continues to stay this incredibly resilient, then the back end has to pop up. And so, we've seen substantial flattening. It's a bear flattener, which is obviously much worse for risk assets. And to Lisa's point before, puts even more stress on forward-looking debt service coverage ratios for those that need to borrow, whether it's households or corporations.
Troy, the fear that people might have right now is a repeat of last year, where we go into a backdrop that's poisonous for bonds and equities simultaneously. Is this a different flavour of that? Do you see that emerging, the ingredients here that leads to this treasury market sell-off that could hit risk appetite as well in credit, in equities?
Yeah, there's certainly going to be some feedback loop, and already has, right? We got back up to 19.9 times forward earnings, only 1.2 multiples below where we were coming into 22, and we compressed back down to about 19. You've seen a little bit of spread widening so far, but because the technicals are so favorable still in terms of a dearth of new supply and still strong demand, credit vol has been remarkably low this cycle. So we don't see anything to the same degree as last year, where, let's face it, the Fed moved incredibly aggressively while they were draining their balance sheet at a record pace. Going forward, it'll put pressure on risk assets. It's certainly going to limit upside. But arguably, the next major downside driver will either be we ultimately do roll into recession sometime next year. And those forecasts, as you know, keep getting pushed back further and further. And or as the Fed continues to drain the balance sheet back at an aggressive pace, and they're finally on the original pace that they intended, that leads to some type of liquidity accident. So those are the two most obvious downside risks now. I think big picture from an asset allocation standpoint, as we're discussing with clients, the tough thing now is that, everyone expected fixed income to at least not lose money this year. And you're back to the Barclays Ag being down through today's price action. And if you look at equity multiples today, relative to risk-free, they've only been richer in the dot-com bubble. And in terms of absolute valuations, they've only been richer in 21 and during the dot-com bubble. So it's really hard to see material upside to equities, even if we don't have a recessionary outcome. And it's much more challenging yet again to have confidence that you're going to get any upside from fixed income anytime soon.
So what do you buy, Troy?
Yeah, so look, it depends on the strategy. From a private lending standpoint, there is what I'd call a Goldilocks scenario emerging, where we can avoid recession, which means we never have a dramatic increase in defaults, but the front end stays longer or higher for longer. And these are all floating rate strategies, so you benefit from higher income for longer. And with the pullback in bank lending, you are not only seeing better opportunities in commercial real estate, but also banks that are offloading assets such as auto loans outright to delever. So it's a great time to be a private lender, but you need dry capital to take advantage of that. In more liquid strategies, our favorite expression continues to be benefiting from slow prepayment activity. This cycle is different than the 09 to 13 cycle, where slow refis were driven by dramatic declines in home prices. So it was tough for folks to qualify for refis. Now it's more driven by just exceptionally high rates, and the probability of rates dropping back to a level where you get high refi activity is very low. And then on top of that, because affordability is plunging yet again because of higher mortgage rates, there's more than likely going to be at least one more leg down in home prices. And then the last thing we'd say is, if you think about the carnage in different markets, there's certainly been the most carnage by far in CMBS in particular. And so that's something we've been studying, watching. And you finally have spreads wide enough where you can really turn the screws on office space. You can look at realistic default rates and pick up excess yield there. So that's another, it's not as liquid, obviously, as IOs or pass-throughs, but something that you can trade around and add some carry and some value. So there's a lot of stuff to do. You just have to be careful and continue to focus on that northwest quadrant efficient frontier. Because if you can make 7, 8, or 9%, that should be pretty competitive with equities on a forward basis. Maybe not mega cap tech, as Dan pointed out earlier, but certainly competitive with most assets.
Just quickly, though, we're looking at 10-year Treasury yields of 4.3%, 30-year Treasury yields north of 4.4%. At what point does that offer something that's attractive and potentially disruptive to this view in other assets that are less liquid that hinge off these rates?
Oh, yeah. So, look, I think if you think of this cycle, the major moves in asset allocation, there's been 2 major moves. One has been to cash, right? We've seen cash levels in T-bill investment activity go off the charts and, north of $1 trillion of capital moving. And then also from smaller regional and community banks to too big to fail banks. Those have been the major reallocation stories. And the reason for that, to your point, Lisa, is now cash and increasingly T-bills and Treasury notes and bonds are becoming competition for other assets. So certainly, one of the major drivers of all the asset inflation we've seen in the last 40 years has been lower and lower rates, right? Which justified paying a higher and higher price for every asset on the planet. As that moves in reverse, naturally, you should have multiple compression. You should demand higher yields in all strategies. You should demand higher total return, even in things like private equity or private equity secondaries, in order to keep that spread to risk-free as attractive as it's been over the last 15 years. So cash and T-bills, T-bonds, T-notes are competition now for all other strategies out there.
Troy, imagine me saying back in March at the lows of the bond market, yields at the lows at 70 basis points on a 30-year. And I said to you, Troy, just wait a couple of years, 442 on 30s. You would not have believed me, would you?
Yeah, well, look, you go back to March, right? And you would say, I think objectively, that recession probability by the end of this year, meaning starting by Q4 or Q1 of 24, was somewhere between 60 and 80%. So if that was the base case assumption, then a 10-year yield had more than likely peaked at 4.23. Now that recession risk has been pushed back so much, credit to the strong labor market primarily, but also to states and local governments and the Inflation Reduction Act, that just means that obviously 4.23 is not the peak in yields. And we've had another surge here, which to Lisa's point leads to more competition with all other assets right now.
We've all been so wrong about so many things over the last few years. Troy, it's got to catch
Humility.
Right? Oh, you need a ton of that. Troy, thank you. Troy Gajewski of FS Investments. We all need a ton of that. If you're just tuning in, welcome to the program. On the S&P 500, believe it or not, even with these moves in the bond market, we're just about positive this morning by 0.25%. Coming up in the next hour, looking forward to catching up with Scott Cronut of Citi on the stock market. We'll do that in about 47 minutes. Neil Dutta yesterday over at Renaissance Macro. I'm from Mars, the Fed is from Venus. This line here. How can these people possibly know that the stance of policy is in restrictive territory? How can they know?
Because rates are a lot higher than they were 2 years ago. I mean, essentially, that's it, right? I mean, this is the key question. Do you believe in long and variable lags? Do you think we just haven't seen the ramifications of this? Or do you believe that it's not having a significant of an effect as people previously thought? This is the key debate, and it's going to be interesting at Jackson Hole where they really weigh in on this. People still say they see signs of weakness. They still say, look, if you look at the retail sales, it's in bargain hunting, even with Walmart.
Recession, 3 months out. Just been 3 months out for the last 18 months or so.
Yeah.
Neil Dutta's line, I have a difficult time seeing how policy is restrictive when the unemployment rate is low and the economy is growing above trend. That's the view from Renaissance Macro. Right now, equity futures just about positive on the S&P 500. In the bond market, a major move. A 30-year yield at a high we haven't seen in more than 10 years. Winnie Caesar of Credit Sites on fixed income, on treasuries, on credit, all of that coming up. AMH is up next down in Washington from New York. Good morning.
One year ago, with your leadership, I signed the Inflation Reduction Act into law. We now have more jobs than we did before the pandemic. And workers aren't just finding more jobs, they're finding better jobs, higher pay, higher job satisfaction. And unemployment is down, and so is inflation. I'm not here to declare victory on the economy. We have more work to do. Bidenomics is just another way of saying restoring the American dream.
The Bidenomics tour continues. That was the President of the United States from New York City. Welcome to the program. Let's get straight to the price action. Equity futures are just about positive. There's a lift to the equity market. There's some really interesting moves in the bond market, though. We've had 6 days of this. Yields higher. Over those 6 days, higher by 30 basis points on a 10-year. 430 right now. Yields higher by 5 basis points. That is the 10-year. Check out the 30-year, the long end of the curve. The higher the session, 442.19, just short of that now at 441.50. Lisa, levels we haven't seen going back to 2011.
I think we're both grappling with when does it crack the equity market? When does it crack the optimism that the U.S. economy can continue to accelerate or at least chug along without any serious pullback? At what point do rates at the levels that we have not seen in 15 years really challenges this idea that we can head toward a no landing or a soft landing? And I really haven't gotten that sort of connection established, and markets are clearly struggling with it.
Tons of curious moves out there. Here's another one for you. Credit, high yield. We're talking about the risk of refinancing next year at much, much higher interest rates. If you truly believe in this higher for longer story, high yield spreads 374 at a close yesterday. 374, that's near the tights of the year.
There is a conviction that the Fed's going to have to cut rates. And clearly people are grappling with this, right? Is the Fed going to cut rates, then create a better refinancing proposition for some of these companies? Or is the Fed going to hold tight? Is the Fed not going to call, say, mercy and say, look, we're going to give you some sort of tailwind at a time where there's already a ton of strength? It doesn't make sense. And yet, as we heard Troy Gajewski say, if you can lock in yields for a longer period of time, why not go into it? And you hear a growing number of people talk like that.
Real yields higher, dollar stronger. Just want to finish on foreign exchange just briefly. One currency pair, dollar China, dollar CNH, the offshore yuan. That currency is stronger against the dollar this morning. It wasn't about an hour and 20 minutes ago. Then this happened. We reported here at Bloomberg that Chinese authorities have told state-owned banks to step up intervention in the currency market this week. Now, is that verbal intervention, Lisa? What does that look like in the week ahead?
And if it's not verbal intervention, to your point, they start selling reserves to try to shore that up. A lot of people think it is verbal intervention. The drip, drip, drip of Chinese officials coming out with half measures, three-quarters measures to try to stave off some of the negative sentiment circulating over the Chinese economy is causing consternation. Why can't they get the message under control? Are they unwilling to bring in a bazooka, or are they unable to? And that really is probably what's underpinning some of the concern.
Change in posture, easing posture, insufficient at the moment based on a price action we're seeing. AMH joins us down in Washington. Anne-Marie, our Bloomberg Washington correspondent. AMH, you caught up with a Treasury official yesterday, Wally Adeyemo. What did he have to say to you about what's developing over in China?
Well, he went one step further than what we heard earlier this week from Treasury Secretary Janet Yellen, who called China a risk factor. She still thinks the United States is best placed to deal with potentially some spillovers that we are seeing from a slowing China economy. But at the same time, what you heard from her deputy is that he really blamed what we see in terms of China's policies as part of the reason. So a little bit of more of a sharper tone coming from Deputy Secretary Adeyemo on what he sees coming out of China. He still wanted to maintain, though, that he thinks the U.S. and agrees with Yellen is in the best place to deal with what we're seeing coming out of China. But obviously, you could see there is a little bit of consternation developing at the Treasury Department in terms of what is going on in China and every day the latest news and headlines we are getting out of Beijing.
Until this year, Anne-Marie, there was this feeling in Washington, D.C. It was anti-China, a look for some sort of divergence between the U.S. and the Chinese economies. And if you talk to businesses, they were very much gung-ho about China, saying that this administration has to understand, or any administration has to understand, that China is a major economy that helps their businesses. Are we seeing any shift on that front at a time where China is not necessarily engaging in internationally business-friendly types of activities on a regular basis?
Well, I think the administration has made it clear what their stance is regarding China, but we have seen them over the course of the year really tread a fine line. They want to make sure they have dialogue and engagement between Washington and Beijing. We've seen a slew of officials go over to Beijing, starting with Blinken, Yellen, Kerry. At the same time, we do see the rhetoric start to ramp up, and that rhetoric is only going to get more divisive, and hot as we head towards the 2024 election. What did we see most recently at a fundraiser event from the current president? He called what Xi Jinping and his economy, basically saying it's a mess and a disaster, and very had hot rhetoric towards China at this moment. And that is only going to increase as as this U.S. president is going to be a candidate for the November 2024 election, but not just from the Democrats, but also on the Republican side as well. And potentially that's going to be uncomfortable for the business community.
And that's the reason why I thought it was interesting that Ken Griffin, did you see the story, John, that Ken Griffin was pushing back against Ron DeSantis, saying that you're being too harsh on China at a time where that is the popular rhetoric going forward, but that he was going to push for some changes. I mean, this is basically going to this point of there's real pushback from the business community that still wants to go into China because it is the world's second biggest economy.
What position would Ken Griffin like Governor DeSantis to take that would actually get him elected?
He didn't necessarily want Chinese real estate purchases banned. There were certain things in terms of investments. But Emery, I mean, I guess that I'm wondering whether this is increasingly tempered and whether the U.S. administration currently thinks that they have more leverage or less leverage based on where China's economy is.
I think the United States feels like they're in a good place when it comes to the Chinese economy. One, on the economic front, they think they are better placed than any other country when it comes to combating China vis-a-vis the economy, even though you did hear from the Treasury Secretary Yellen say there is a risk factor, but she said she wants to be clear. It is just risk at this moment. She does not see those spillover effects happening immediately or even touching the U.S. economy. Also, what you'll hear from this administration is that they've been trying to build out a more secure supply chain. And this is going to be top of the agenda, especially tomorrow, when the president will be sitting down with the leaders of Japan and South Korea in this trilateral summit at Camp David. Part of that has to do with security when it comes to North Korea, but also a big part of that for this administration is making sure they are having a collective way to combat China with some of their most closest allies in the Indo-Pacific.
Can we squeeze in just the last one? My go-to question of the last few weeks, the former president, is he showing up next week?
I still don't know, to be determined. One thing is for sure, he has to show up in Georgia to turn himself in along with the 18 other defendants in this case before August 25th. Some people are saying maybe he does that on Wednesday and then the debate basically comes once again about him and he takes all the oxygen out of the room, whether or not he's physically there or not.
What's new? Anne-Marie, thank you. AMH down in Washington, D.C. Appreciate it, as always. I'm not sure it's in anyone's interest for any of these economic issues in China to unravel in a disorderly way. At the same time, I'm not sure it's in anyone's interest running for the presidency right now to say anything other than they are already saying. You hear it from Republicans, from Democrats. There is just seemingly this belief to be elected in America now, this is the position, the stance you need to take on China.
Which is the reason why I thought that it was interesting about Ken Griffin going after Ron DeSantis and saying, hey, stop it with banning a lot of foreigners from buying property, particularly in South Florida, particularly from China, because that affects his business. And he is probably one of the wealthiest people, or if not, the wealthiest person in Florida. Money talks. And we can see that with Iowa, too, just in terms of Republican policies. How do you talk about immigration at a time where they've got a really low unemployment rate and they need workers? I mean, these are some of the issues that are testing some of the classic talking points.
Yeah, sometimes good economic policy doesn't make for great electoral politics. Sometimes. Yeah. Sometimes. Winnie Caesar of Credit Sites joining us shortly on the credit market. Equity futures right now on the S&P positive and yields a whole lot higher over the last month or so. From New York City, this is Bloomberg. Two days of losses in the equity market and plenty of headlines in the bond market. Futures this morning positive by 0.2% on the Nasdaq. There is a lift here. We are still heading, though, poised for a third week of losses and only 2 sessions left of the week to do something about it. In the bond market, yields higher for 6 consecutive sessions on a 10-year, just short of 430, Lisa. There it is, 430.18.
And it comes with the 2-year yield coming in, which is important. This idea that this isn't driven by necessarily Fed policy and Fed rates going higher. This is driven by, over a longer term, a feeling that there's going to be less demand for U.S. Treasuries relative to supply. It's not really clear exactly why. It's not exactly clear how far this can go, but that's the mood right now in markets.
When did we last see the 30-year this high?
2011.
2011. 441.60, and earlier this morning, 442. Just amazing, Brammer, that this was at 70 basis points in March 2020, and here we are 3.5 years later looking at 440 something.
I think about private credit, private assets that yield 9%, and people are saying it's so great to lock those in. But if you look at a 30-year yield at 4.4%, where the obligor is the world's biggest economy, full faith and credit of the U.S. government, at what point does that change what risk you're willing to assume for what yield in a more material way?
The whole curve just shifting higher over the last month. It's been amazing to see. I want to finish on the FX market just briefly. One currency pair, dollar China, dollar CNH to be precise, the offshore Chinese renminbi. That currency is stronger off the back of this report from us here at Bloomberg that Chinese authorities have told state-owned banks to step up intervention in the currency market this week. But that move, Lisa, just starting to fade again in the last 10 minutes.
Again, where is the conviction that there will be some action to back up the rhetoric? And that, I think, is lacking right now because there has been a very big noise from Chinese officials, but not necessarily the actions to back it up. And that's been consistent for the past couple of weeks.
China, 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 the story every single morning, seemingly over the last couple of weeks or so. Under surveillance this morning, a Treasury sell-off in the spotlight, pushing global government bond yields to 15-year highs. We've had stronger data, confusion around yield curve control, more supply, the BOJ all over the place, problems in China. Lisa, take your pick right now, pick your poison.
Yeah, well, I'm really unclear on this. And I'm also unclear why there isn't more buying, considering all the people who are really bullish on bonds. If you wanted to lock in yields at substantially higher than they have been in a very long time, well, welcome. Here's your moment, right? Where are they? And who is selling? Is it just something technical? Right now, the feeling is there is a sea change in terms of quantitative easing being reversed and being reversed on a global scale with all of those underpinnings being released.
Getting closer to 5% on a 10-year in the gilt market. The UK 10-year yield, 471, higher by 28 basis points over the last month or so. There are plenty of issues over in China at the moment. Here's one. One of China's largest private wealth managers is tapping KPMG to restructure debt amid a growing liquidity crisis. We're reporting here at Bloomberg that Zhongji is looking to renew its balance sheet and sell assets in order to repay investors. Meanwhile, rare protests, Lisa, you mentioned this, of about 24 people breaking out in front of the offices of one of the shadow banks as investors worry about missed payments. These are just things coming to the surface again and again over the last few days.
So in one video clip, a woman is seen saying, "Why doesn't the company pay us back?" These are clips that are getting out of the country, which is unusual. This is a country that wants to manage the message, especially at a time of distress. At what point, though, does this highlight the contagion efforts, the contagion risks, I should say, of the housing market, which underpinned a lot of these investments? How far does this go? And at what point does that go more broadly outside of China as well? Again, we don't have a sense of that. And right now, markets in the U.S. are shrugging it off.
Let's finish here on Walmart. Walmart out with earnings in the last hour, raising its annual profit forecast for the second quarter. The second straight quarter after scoring new sales gains with bargain-hunting US shoppers. This stock is up by 1%. Question I asked last quarter when this happened, and they raised their guidance last time around. If Walmart's raising their guidance, is that a good thing for the US economy? Is that a good sign of what's happening?
It's a great question. I don't know the answer. Why is it that the companies that are doing the best in retail are the ones that sell discount products? Why is it that the bargain hunting types of places are really showing the gains, whereas the mid-tier not so much, luxury only those that really cater to the ultra wealthy? At a certain point, doesn't this indicate that there is softening, that there is perhaps cash that is going to get run out at some point?
Well, let's hear it from Walmart. Brendan Case here at Bloomberg speaking to the CFO. I'll share a quote of that interview with you all. We're gaining share and our value proposition continues to resonate both for value and convenience. That's the happy talk, the corporate speak. Here's the line of interest. The consumer is still spending, but they're being discerning in their spending. That's kind of where we're at, Lisa. It's not obvious, but there are subtle signs.
And does this really eliminate pricing power? And for who? does this sort of start to lead to consumer pushback? We're seeing it in certain areas, not in others. I mean, restaurants are packed. Have you seen how much more it costs?
Depends where you go, yeah, but getting expensive.
Hold on a second. Depends. It's all more expensive than it was a year ago.
Oh, no,
it's like
absolutely.
twice as much.
McDonald's is expensive now in Manhattan. Like, it's serious
is that
money.
Would you go?
No, but it is expensive if you wanted to go there.
Okay. You're just channeling TK.
TK frequents McDonald's.
Yes. Oh, yeah, big
That's
time.
his thing. Winnie Caesar joins us now, Global Head of Strategy over at Credit Sites. Winnie, we've talked a lot about fixed income, yields higher on a 10-year, 30-year. Let's talk about the other side of fixed income, credit. Walk us through why credit spreads are so tight still and near the tights of 2023.
Hey, good morning, Jonathan and Lisa. Thanks for having me. So credit spreads are definitely still at the tight end of the range, which is quite shocking. When you look back at when the 10-year was at 424 last October, investment grade spreads were making their wides for last year around 170 basis points, whereas they're now around 120 basis points. I think there are a few factors. First is the material shift in expectations for fundamentals getting a little bit more positive, seeing the path for a potential soft or no landing is generally a positive thing for credit spreads. I think second, it comes down to positioning for much of the year. At the beginning of the year, people were still pretty bared up on the outlook for the economy. And with that, people were not necessarily putting a lot of cash to work in corporate credit. And it feels like a lot of investors have been chasing the trade as spreads have tightened over the course of the year. And then the last one is just technicals. We have not had enough new issues supply to really put a dent in the demand that there has been for fixed income. When you look at corporate credit relative to equities, it still looks very attractively valued. And so we do think that there is that marginal demand that's going to continue to support credit spreads, although we don't think that we're going to get much tighter from here.
Winnie, John asked me a question earlier this morning. He said, how do we know that rates are restrictive? And I kind of hemmed and hawed and tried to come up with something to say in the moment. It's a great question, though, at a time where risk assets are saying that this economy can look through benchmark borrowing costs of 4.3%. At what point do yields rise to a level where it's clear that they will have an impact on the ability for some of these companies to refinance, on some of the economic momentum that everyone keeps relying on?
Yeah, it's an absolutely great question. And I think there's a lot of confusion around restrictive policy and what it really means. When we look across the broad spectrum of corporate credit, we are seeing that rates are restrictive, or policy is restrictive for those lower rated, highly leveraged borrowers that don't have sustainable capital structures. Defaults are rising, not at a super rapid clip, but definitely at a pace that indicates that there has been tightening in the economy. We've also seen a shift in terms of how management teams are talking about their balance sheets, a move to a much more prudent and disciplined capital structure endeavor, so that we're not seeing a lot of pressure on the rating side of things, trying to avoid a downgrade from investment grade to high yield, trying to maintain ratings and really maintain access to capital through a bunch of different avenues. We're seeing not just management teams issue corporate bonds, but also pursue kind of unique structures through securitizations and other transactions.
What I'm hearing from you is that a lot of corporations have immunized themselves against rates and against rates going higher. We've heard that with the consumer with respect to mortgages that are locked in for 30 years. We hear that with corporations that are readjusting their balance sheets and reducing their need to borrow. We're hearing that from a whole host of places. Is the implication here that right now, longer term rates at 4.3% are not sufficiently restrictive to really materially put a dent in any business model that we can see right now out there?
Well, I think that it is putting a dent in some business models. There are definitely business models, particularly in the leverage loan space and likely in the private credit space, where they are running into liquidity challenges, where they are running into challenges around capital structure sustainability. It's just not the big kind of U.S. investment grade corporate issuers that are running into trouble at this point. Eventually, higher yields will become an issue, but so long as earnings are kind of good enough for credit and earnings are growing at kind of an inflation adjusted pace, then much of the corporate credit universe should be in fundamentally pretty sound shape. And the Fed's restrictive policy is not necessarily intended to cut off access to the investment grade world. They want to see investment grade companies able to borrow. They still want to see high yield companies able to borrow. They just don't want to see kind of risk taking or highly risky behavior within the corporate credit market.
Winnie, within the loan market that you just mentioned, how pronounced is the default cycle that you're seeing emerge?
So the loan market on a default basis is actually not particularly pronounced. And that has to do with some of the kind of structural considerations in the loan market where you have the ability to amend and pretend. So capital structures can just be amended and kind of push out those maturities. And we don't necessarily have to see a true default event. Now, what we are seeing is on a fundamental side, very low interest coverage ratios, especially for CCC rated loans, which are now a higher percentage of that market. And so while we're not seeing the defaults necessarily pile up, we are seeing a lot of sponsors kick money back into their portfolio companies to make sure that they can make it through this, what is perceived as a relatively short-term spike in borrowing costs, especially for those floating rate aligned capital structures.
I guess they hope it's short-term. Winnie, wouldn't that be the right way of framing it?
That is very true. They hope it is short term, and hope has not necessarily been the best strategy.
Winnie Caesar of Credit Sites. Winnie, thank you for that. That is the hope right now. Lisa, we talked about it. The hope that this refinancing issue on the horizon, this so-called maturity wall, particularly in high yield, is something we don't have to worry about because the Fed will be in the business then of reducing interest rates because inflation is coming back down, and we'll be talking about the economy recovering out of a downturn.
What I just heard, though, from Winnie Caesar is that a lot of companies, and I would add consumers, that's my words, are able to handle higher rates because of how they've handled their balance sheets, which raises the perspective that we could see rates higher for longer. And that's what people are trying to game out. So at a certain point, that wave of refinancing becomes a real issue because it's coming up next year, the year after. And so at a certain point, you start looking at this, you start connecting the dots, and it's not all adding up in the right way.
Nope. If you're just tuning in, welcome to the program. On the equity market, we're positive here by 0.2%. Joining us shortly, Matt Lazzetti of Deutsche Bank. He's upgraded his view for third quarter GDP. He's going to join us in about 48 minutes' time. Lisa, just to build on what you were talking about, it's intriguing what's happening in fixed income right now. The comfort people have about this maturity wall's just a problem we don't have to deal with. It's out there and we don't have to deal with it because rates are becoming lower in the future. But right now, that's not the story. That's not the story at all.
In order for rates to go lower, there has to be some reason for the Federal Reserve to cut rates and for people to game out slower growth. There has to be some pain, to use Jay Powell's word from last year. Where is the pain going to come from if these companies see a better economic opportunity? Their business models are stronger. We see stocks rallying. Something's not adding up because there's not a reason for the Fed to cut rates, which is the reason why in Jackson Hole I want to understand what is that threshold?
You know who might want a rate cut? Treasury. These consumer balance sheets are so strong because we had a massive transfer from the sovereign to the consumer throughout the pandemic. That's why they're so strong. Rates were so low, which allowed corporates to lock in low borrowing costs and extend these maturity walls. That happened with credit. That didn't happen with the Treasury. The Treasury did not do that in a pronounced or material way in any way, shape or form. So here we are. I mentioned this yesterday. If you really think it through, the sovereign balance sheet got weaker to enable the consumer balance sheet, the residential balance sheet, to get stronger. And here we are looking at a treasury market selling off and credit spreads are still what? Tight, and the consumer still doing okay?
So when does that break? When do the sovereign yields matter more than the strength that you see elsewhere?
From New York City this morning, this is Bloomberg.
It's the consumers at the lower end of the spectrum that I think are being a bit more cautious. And so when you look at our China business and the growth we're talking about, the margin profile is dramatically improved as well, because actually the consumers that are a little further up on the chain are actually performing a bit better than consumers at the entry level. I'd argue that U.S. has been feeling pressure on the consumer side, but the travel demand is tremendous.
Absolutely tremendous. That was from the Samsonite CEO who knows something about travel demand. Intriguing to get the corporate view on what's happening in the economy, particularly in China. If you don't trust the economic data, you're worried about transparency, it's good to get a look through a company and to their lens through China.
And what we've seen, price cuts, we've seen downgrades, we've seen concerns, possibly retracement and pulling out. That's the reason why you see this this negative feeling right now around the world's second largest economy.
Let's turn to equities. S&P 500 futures elevated, still doing okay, positive this Thursday morning. Treasuries, not so much. Down hard over the last month or so. It's 6 consecutive sessions of yield higher, this time by 4 basis points, just short of 430 after breaching that level earlier this morning. 429.19, Lisa, on a 10-year.
This isn't adding up to me. I'm not understanding whether there is a level on treasuries that's established as being sustainable in the U.S. economy for risk assets to keep doing well. This is a connection that has not been established, and it flies against what everybody was saying 6 months ago. The rates at this level on the long end should disrupt risk assets, should disrupt risk-taking abilities.
Not happening this morning.
Not happening in any way.
Not happening this morning. One company that's doing well, Walmart, once again raising its annual profit forecast. This for the second straight quarter. The stock is higher here by about 1.1%. Better numbers, a beat on a top and bottom line, and a raise to the outlook as well. Joe Fowden joins us now, the Senior Research Analyst and Assistant Director of Research at Telsey Advisory Group. Joe, great to catch up with you, sir, and good to continue this conversation on US retail. We asked the question, I know you've got the answers. If Walmart is doing well, what about everybody else?
Yeah, it really does reflect that there could be some concern for other parts of the economy. We continue to see the high end doing well. The low end is seeking value. The middle income consumer has been trading down and seeking value. And now we've seen that with Walmart. Amazon recently had very good results. And even Target yesterday, their food and consumable side of the business was pretty healthy. And people were trading down there in that area. So, we're seeing increased traffic at Walmart. You're seeing higher sales of groceries and basic items and consumables. So, the consumer's still putting food on the table, and that's an area of focus. But discretionary has been soft. That's for sure.
Joe, how much clarity have you got on where margins are going to be over the next couple of quarters?
Yeah, I'll tell you, Walmart keeps putting up better margins than expected. I think the lower freight costs are helping. And that's helping all of retail. Remember, a year ago, 2 years ago, freight costs were through the roof, especially ocean freight, and that's come down quite a bit. So that's actually helping to provide a little bit of a tailwind and give some confidence, I think, for Walmart and others to raise numbers for the back half. I mean, the others are not doing that, but Walmart for sure, their raise that they gave is just really that confident in the fact that they're getting the traffic, they're getting the sales on the top line, and, they really are getting the profitability they need to drop to the bottom line.
Joe, when you look beyond Walmart, when you look beyond Target, when you take a look at other retailers, do you have a sense of discretionary spending money that people have parked in the bank? Do you have a sense of whether consumers are running out or whether they're doing just fine?
Our view is that the consumer is under some pressure, and they have some money to spend, but it's only in pockets. So if you've planned a trip and you're going to Europe or you're going to other parts of the U.S., or if you've planned a big event, you're going to Taylor Swift concert, that might take up a good chunk of your discretionary dollars that you would otherwise have spent on some goods. And I think during the pandemic, when we saw people spending a lot on goods, especially home, and coming out of it, you saw a lot of spend on apparel last year, those dollars have kind of shifted elsewhere. So, we've looked at credit. I know consumer credit's been rising, but not to alarming levels as of yet. And so the consumer is out there and able to spend it at the moment. Wage growth is still pretty solid. Employment levels are good, but they're not spending broadly. They're just spending within different silos. Obviously, food is one of them. But right now, services, going out to eat, while that is starting to moderate, they have been spending there versus goods.
This sounds prudent. This sounds like good balance sheet management. This sounds like actually responsible consumer spending habits. Doesn't it seem sustainable and doesn't really speak to some sort of broad slowdown in retailing that a lot of people say has to happen, or consumer spending that has to happen for the U.S. economy to soften?
Yeah, I think that's a fair statement. I think that, when you look at retail broadly, again, anybody offering value, those catering to essential goods are doing well. Where was a lot of pull forward of demand during the pandemic, we're still in a normalization phase coming off of that. And I think the consumer has been very prudent with how they've been spending. And, we're hopeful that we're going to have a solid back half and a decent holiday season. We'll hear more from Walmart when they speak in a few minutes. But, it just seems that the consumer has been more resilient than I think a lot of us have given credit at this point in the year.
Before you run off for that call, and I know you've got to listen to that, Target yesterday said this, Joe, that the resumption of student loan repayments would cause additional pressure on strained consumer budgets. Lisa's been saying this all week. The White House instituted a 12-month on-ramp. Are they just setting up a decent thing to blame later on this year? Joe, what's your read on that?
Yeah, well, so we did a deep dive report on this and an analysis of student loan debt. And, there's 17% of the U.S. adult population has student loans, federal student loans, that are going to have to start being paid back. Now, they won't be penalized perhaps for a year, so there's a little bit of a grace period. But, our thought process on this was that middle income, middle to upper is where you start to see more of that pressure. Those are the people that do have the student loans. Target's customer is really that customer. And so we called out in our report that we thought Target was among those that might see a little more of an impact from student loans. Maybe less so at a place like Walmart, which sells so much grocery and people have been trading down and seeking value. You don't quite have that at a Target. So I think there is some reality there. I don't think the student loan thing will be broad-based for everybody. Again, the very high end won't be an issue. And then the low end it may not be as much of an issue either. It's really the middle that, once again, is going to get squeezed on this.
Joe, I'm just curious where we are in some of the durable goods sectors, which a lot of people are wondering how long can keep contracting. Are we at a point, an inflection point to the other direction, where suddenly people are starting to go back to things that they shunned after the mass binge buying during the pandemic?
We started to see through the summer some early signs that you might be seeing a little bit of a shift from the services back towards goods. And we're hopeful that will continue into the fall. And, holiday will come, Christmas will come, kids will get gifts, so that spending will happen. We're hoping that shift is a little bit more aggressive back towards the goods on the retail side of the sector. But it seems, again, that there are some initial green shoots there that the good spending might start to come back.
I thought you were going to break out into a Christmas song then, Joe. I hope the kids get gifts.
Kids will get gifts.
I hope they get gifts.
Well, maybe they'll get something under the tree.
Joe, thank you. Joe Feldman at Telsey Advisory Group. I hope they get gifts. That sounded sad, didn't it?
It's like in this complete monotone. Kids will get gifts, and it's, typical.
So we've got back to school.
Yeah.
Holiday season coming up. And it is coming up. I know it's deep into August, but
it's so not coming up.
Well, for them it is.
Okay,
you're going to walk into the store in 2 months' time.
It bothers me.
In fact, in a month's time, you're going to see the Christmas trees out.
This absolutely bothers me.
You're not alone.
I'm starting to see Halloween candy in the stores.
Obviously,
Are you joking me? And as soon as Halloween's over, you see Easter bunnies. And I mean, it's like, come on, that's, how many months away? 5?
Easter bunnies come in about January, yeah.
It's ridiculous.
No, I know it's ridiculous.
I mean, and it's the second that Thanksgiving is over, Christmas carols everywhere.
I like Christmas carols before Thanksgiving.
But constant? And then all of the Christmas...
I love a Christmas song.
Okay, all right.
I love a Christmas
Are
song.
you going to sing for us?
No, I'm not. TK would, but Tom's not here. I miss him.
Yeah, we all do.
We'd like a song going out to break. Scott Cronut of Citi on equities coming up very shortly. That conversation just around the corner. Equities right now doing okay in the face of a bond market that keeps selling off. Treasury yields higher here by 4 basis points on a 10-year, 429.19, and the highest yield we've seen on a 30-year going back to 2011. From New York, this is Bloomberg.
Welcome back to another special Western and Southern Open update for Bloomberg TV and Radio from Tennis Channel. I'm Erin Coscarelli. Team phenom Coco Gauff moved into the 3rd round in Cincinnati with a victory over Mayar Sharif under the lights Wednesday night. The victory was the American's 7th win in 8 matches after she recently took her 2nd title of the season in Washington, D.C. And don't forget, you can watch all the action live 11 a.m. Eastern on Tennis Channel. I'm Erin Coscarelli.
There's a lot of good news out there, but the market, I think, has become a little callous to it.
What is clear is that there is more pain to come, even if rates are already at a peak.
We think inflation will be back to target by the end of next year.
The good news is we're near the end of the Fed tightening cycle.
Are they done? I don't know. There's probably some more room left to move higher.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Decade highs on a 30-year yield. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Your equity market, in the face of that, doing okay. 2-day losing streak and bouncing back by a mere 0.25% on the S&P. But these moves in this bond market, Lisa, they continue.
To me, this is the key question, the connection between bonds and risk assets at a time where people were thinking about bad news is good news and good news is bad news. Good news is still not terrible news, even though for the bond market it is. And at what point does that shift as people say that yields are too high to sustain the growth that we've seen?
A week away from Jackson Hole and Chairman Powell potentially speaking. What do you reckon he's going to have to say about this?
Does he lean into the market moves? Does he say the market is waking up to what we've been saying for a long time, which is that we're not going to cut rates anytime soon and that we're going to hold rates in a restrictive posture for a prolonged period of time? If he doubles down on that, does that create a more sustainable feel in the market that we currently have and potentially a more significant response in risk assets?
I'm thinking of one policymaker in particular, Neil Kashkari of the Minneapolis Fed, who's taken a lot of stick over the last few years, and I understand why. But his view at the start of the year has stood the test of time over the last 8 months or so. He said, phase one, let's get yields up quickly. He thinks maybe 5.5%. Once you're there, phase two, hold. Push back against that. 8 months ago when people were talking about, can't go too far, and ultimately when they do get there, they're going to have to cut quickly. His view has stood the test of time pretty well so far this year.
This market has been wrong, consistently wrong about how high yields could go and how strong growth could persist, how much consumers could keep spending, how much companies could adapt and adjust. I feel like I'm terrible saying this. However,
you're in the seat.
I'm in the seat, so I have to say it. But that is what has transpired. And at a certain point, then you have to wonder, how does this shift the entire investment regime if rates stay above 4% for the next decade or for the next 3 decades?
Consumer resilience, the story of the year so far. Upside surprises in the US economy. Numbers from Walmart in the last hour or so. Walmart's doing well. Raised their guidance for a second consecutive quarter. You and I have just had the conversation with Telsey Advisory, and basically they're saying, OK, Walmart's doing well. What does that mean for everybody else?
And what Joe Feldman seemed to be saying was, well, if you look at consumer balance sheets, they're being prudent. They're actually being responsible. U.S. consumers are doing what people should do, which is balancing their budgets and deciding where to spend. And so they might spend a little bit more on Taylor Swift tickets, but then they'll pull back in terms of what types of luggage to get for their next trip.
Have you seen the price of them? I mean, come on.
But the reviews are really, really positive that people, when they go, they're very happy. I'm not a
spend
Swiftie,
like
but
$20,000 US.
Okay, but that's only for certain premium
I've heard the
seats
cheat
and such.
guide is that you go abroad to like Argentina for that leg of the tour.
You've got the inside knowledge.
The tickets
You've
are
got
cheaper, and then everything else is cheaper with it because the dollar's so strong and all that good stuff.
Yeah, and then you get central bank reports saying that the reason why inflation is so high in our nation is because of Taylor Swift. And so, or the Beyonce, right?
Beyonce
that was the thing
tickets.
We saw Sweden, I think.
Sure. These are the problems we got stateside, right? In China right now, they've got real problems. The currency, the focus this morning. There was a story that we put out in the last couple of hours. The Chinese authorities have asked state-owned banks to intervene in the FX market this week. The potential of FX intervention in China, the potential, and I stress potential over in Japan because we've heard little about it, but we went through the levels on dollar yen in the last 24 hours that we breached in the last 12 months, which triggered intervention from the BOJ. So all of this stuff developing in FX too.
You raised a really important point earlier when you said, maybe the U.S. is doing okay, but maybe things are starting not to break, but to really reach a breaking point outside of the U.S. because of the moves that we're seeing in yields, because of some of the moves that we're seeing with even dollar strength. It's a good question to understand the interconnectedness of this. At what point do higher yields in the U.S. break things elsewhere at a time where China is very much in a difficult spot and Japan is going to stick with their yield curve control, maybe, but abandoning it around the edges.
It's really early days, but dollar strength is not the friend of what's happening in China or in Japan more specifically at the moment. Let's turn to the broader price action on the equity market in the S&P 500. It's just okay, no drama right now. We're positive by 0.2%. The drama has been in the bond market, a 10-year yield through 430, 428, 80, potentially a new closing high a new closing high potentially for the cycle, and a 30-year. We're through the highs of the cycle intraday. You've got to go all the way back to 2011. And we've got a question. How much of a challenge is this bond market posing to equities at the moment? Scott Cronin joins us now, US equity strategist and managing director over at Citi. Scott, great to catch up with you, buddy. And let's get straight into it. How much of a challenge is that bond market to your stock market?
I think it's a big challenge. I think with the perspective here is that the shock effect on rates, in my view, was last year. Okay, as we were going from negative real to positive real, and we were getting comfortable with the changing Fed regime, that led to that very massive multiple correction last year that drove the NASDAQ and the broader market lower. This year, we've gotten a little bit more comfortable that a peaking Fed is in sight. And as the markets rally through this year, the market implicitly has gotten comfortable with the 3.5% to 4% 10-year, which is where most of the trading range has been. So as you begin to move higher through the 4.25, and maybe we're looking a little bit higher, you do begin to reintroduce this issue that as you move away from the AI narrative and re-engage in other stories, rates becomes that, and it does become, in our view, a reason for a pullback phase after the run that we've had in the first 7 months of the year.
Okay, maybe this is a stretch, Scott, but next week, NVIDIA reports earnings. NVIDIA, which has been a major contributor not only to the rally with a 200% gain so far this year, but also to this AI narrative. If they disappoint, could this be a catalyst to rethink the interest rate sensitivity of the biggest component of the index, which is tech?
Well, I think that's certainly part of the narrative here, right? I do think that as we look at this AI narrative, and it is important in terms of an incremental growth driver in the next couple of years, I think the market is still giving many of these companies some room, okay? You're announcing initiatives, but the follow-through from a revenue and earnings perspective is still several quarters out. So I do think we need to be cognizant that the market is comfortable with this incremental new growth driver and potential engine for growth as we look in the 24-25 time frame. But I do think we'll continue to get tested in terms of are you continuing to feed that narrative with enough incremental news to keep it moving? Our view is that there will be enough information here, but you do have to be aware of setups. Where we've been focusing on is the implied expectations for many of these companies. And in some cases where implied expectations get way ahead of consensus, there is some risk.
We've been talking all morning about at what point can this equity market, can risk assets in general keep rallying or at least sustain current valuations with rates significantly higher. It seems as though the actual strength in earnings has defied a lot of expectations. The ability to rearrange balance sheets has defied expectations. And in a world where people are not sure of a bond yield, equities have been a haven of sorts. How long can multiples keep expanding, even in the face of higher rates, given this resilience?
Lisa, the highest correlation I can find between equity performance and drivers over long term is with earnings. Okay, 0.95 R squared going back to the early 60s. Earnings tends to lag S&P price action by, let's call it, 9 months. Okay, so essentially what happens here is this move in the market is setting up expectations that you need to see earnings follow through. Now, in our work, we actually do think that we're going to see earnings acceleration next year. We're looking for low teens earnings growth for the S&P 500, and we get there through several metrics. But essentially, that becomes the issue. I think what we've seen this year is a more resilient earnings picture. We've been talking about that for some time. As we look ahead to 2024, you do need to factor in soft landing or not. But the way we think this is setting up is that you're going to see the earnings growth next year to support this. And more importantly, we're starting to look at an inflection in free cash flow. And free cash flow growth is really critical because what it does do, to your point, Lisa, it really opens the door in terms of financial flexibility for how C-suites respond and engage in activities, whether it's repurchase activities, capital spending, or even debt pay down. So the flexibility that comes with improving free cash flow is pretty important. And we have to keep in mind the starting point is that free cash flow levels improved roughly 50% in the 2 years coming out of the COVID recession. So again, we think there's some angles here fundamentally that provide ongoing support for the equity markets.
So at what point do you step in and really start buying significantly some of the areas that are getting beaten up over the past couple of sessions?
what I would say is that my benchmark, and this is pretty subjective, is that you have a run of this magnitude, and you have to presume that somewhere in there you have to get a 5 to 10% pullback. And if the fundamentals are still in place as we think they're going to be, then that's the metric that I'm kind of using. So, your starting point is in that mid 4,500 level.
Scott, I just want to finish on the retailers, if that's okay. We're just hearing from the Walmart CEO, Doug McMillon, and he's saying that the headwind that they see coming is going to come off the back of US student loan repayments. We heard something similar from Target, who said the resumption of those payments will cause additional pressure on already strained consumer budgets. Scott, have you and the team done any work on that, on what effect you think that's going to have on earnings from some of those names?
Yeah, it's something that we've had on our radar for a while. It's very hard to get granular on it and bring it down to company specifics, and can't really do that here. But what I would say on this is that with the retailers, there are a couple of things going on. First, expectations for consumer discretionary came down the hardest last year of any sector, okay? So the setup going into this year is an interesting one where a lot of the negative concern regarding recession risk is priced in. You kick the can on recession and the consumer's a natural fallout of that. Yes, we're going to have to contend with higher inflation impacts, higher interest rate impacts, throw in student loan debt issues kind of coming in here. You still have rising wages, and you still have an angle here where there's an offset to student loan payments for a certain consumer cohort. It's what you're now earning on savings. So there are some balances on this. What I really think is important, though, in looking at the retail landscape is the result so far is how these companies are able to manage a fairly mixed setup, right? These companies are, in our view, at the cutting edge of how we think about utilizing technology to better manage your business, and in so doing, you avert a lot of the traditional business cycle effects. And so this is a theme that we think gets underplayed in the market, and the results so far with the retailers seem to support this notion that they're actually doing a really good job of managing what they can control on this. And that's kind of showing up in terms of earnings and margin profiles.
Interesting. Scott, thank you, sir. Scott Cronin there of Citi. Busy morning for everyone at the moment. Equities right now in the S&P 500, if you're just tuning in, positive here by 0.2%. Coming up on the US consumer, on the US economy, on the US labour market, Matt Lazzetti at Deutsche Bank, who recently upgraded his call on third quarter GDP, reacting to US jobless claims due out in about 15, 16, 17 minutes. Lisa, it's the blame game on Wall Street, and it starts on Main Street pretty early for Target and Walmart ahead of these student loan resumptions.
Yeah, and what we heard from Scott Cronin there is saying, well, they at least have gotten more efficient at cutting costs at the companies to be able to maintain some of these headwinds. Again, we keep talking about how much of a headwind is actually going to be. I mean, if there are people who are already planning not to pay, then you have to wonder whether that's going to limit some of the damage, the bleed through. I mean, eventually they're going to have to pay, presumably.
If there's a 12-month on-ramp, which you mentioned earlier this week, if there is a 12-month on-ramp and you're going into the holiday season, wouldn't you just start paying like in the new year? Isn't that when you'd expect that headwind to hit?
Is that
if it was me,
do?
that's what I would do.
This is you do because the kids will get gifts.
There's no punishment whatsoever to wait.
Yeah, exactly.
So why wouldn't I just wait?
Which is what a lot of people are gaming out, which is the reason why it won't be that substantial of a headwind. Some people think, but evidently Walmart and Target do, and it's something to consider.
Just kind of lowering the bar, aren't they, as we get to the back end of the year? Maybe. James Athey of Aberdeen coming up next from New York City. This is Bloomberg.
You take 2.5, and for inflation, you take 1.5, and you take 75 basis points, which is lower than history, for term premiums. You're looking at 475 on the 10-year, and it obviously could end up being higher than that.
I love Larry. He's obviously fiercely intelligent. Larry Summers there, the former US Treasury Secretary, but that sounded like a chef making a meal. You take 2.5, you throw in 75, you take another 1.5.
It's true.
Bramo, you get to 475, and that's where the 10-year's going to be.
The way he talks is so it's just
Bang.
Obvious. Come on, this is where we're heading
and then he's
now.
going to tell us it was never a forecast. It was just an economic model. It's just a way of thinking about the
it was
Treasury
a recipe
market. Yeah.
For a ratatouille. of monetary policy.
Give me a break. In the bond market right now, on a 10-year yield, let's call it about 430 on a 10-year. I won't slice and dice that for you. I'll slice and dice the 30-year for you. The 30-year yield at a high we haven't seen since 2011. What, slice and dice?
Yeah, that was good. That was really
nice,
good.
Nice.
That was good.
Let's just get to James Athey over in London, investment director over at Aberdeen. James, great to catch up with you. It's like the question of the week. What's it all about, James? What's behind this bond market move?
Hey, John. Yeah, I mean, it's a good question. It's been a very strange few trading days. We had stronger US data and the market seemingly couldn't sell off at all. And then we've seemingly got these kind of random sell-offs out of nowhere with not much behind them. I mean, Larry Summers there, I agree with you that it's all a bit spurious, some false accuracy in there, but I think that term premium element is certainly part of it. But if you look at the equity market, 11% earnings growth price for 12 months ahead in the S&P and trading at 20 times roughly, that looks like a pretty nice, if not soft landing, yet you've got this massive inversion in the bond yield curve. One of those is wrong, and it looks like they're kind of converging from both directions, which is probably reasonable given the data we're seeing in the US.
Does it make sense to you, James, that we're seeing risk assets hold in there despite some of the moves that we're seeing in benchmark bond yields?
Is that a loaded question, Lisa? Because you and I tend to be the only bears that are speaking publicly.
Carry on.
I found it difficult to explain or justify really that rally in the equity market from a fundamental or from a probability-weighted, risk-adjusted basis. It looked like there was a lot of short covering in that, in spite of the fact that obviously the economic news has been better than expected. So I am generally surprised at how well equities can ignore some of the macro drivers. But it's hard to pick holes in, for example, retail sales data this week. It's hard to try and claim that the consumer is on the precipice when the spending numbers are as strong as that. And so whatever the data's okay, I think equities can hang in there.
What about credit? We were talking about how narrow credit spreads were, and we were talking with Winnie Caesar about how much companies have readjusted to prolong some of their payment structures and increase their cash, shore up their ability to maintain themselves through this period. Are you getting bullish on credit, or do you think that it's over its skis? How do you sort of rationalize?
Well, so I think the spreads are too tight, broadly speaking. I don't think you're really being accurately compensated for the likely default risk. You can see that realised defaults in most countries and regions have been ticking up to a far greater degree than we've been used to. So I don't think the spread component is necessarily attractive. But what the bulls and a lot of credit guys will tell you is that the all-in yield is very attractive, obviously because of the cheapness of underlying government bond yields. And I think that's reasonable. So I think if you're being selective and choosing high-quality corporate credits, you've probably got some nice investment opportunities there. One of the really interesting charts that I've seen recently has been that a lot of companies have actually benefited from higher rates. You know, they engaged in precautionary borrowing sort of for 5 or 7 years when rates were low, and now they get to park that cash at the deposit rate or at cash rates, which are 5.5%. And so in spite of this monetary tightening, it's actually generating positive cash flow for a lot of these cash-rich corporates.
Hey, James, we've talked about this kind of stuff before, but there's often a geographic, regional bias on certain issues. If you ask someone in New York on Wall Street about China, shrug of the shoulders. And the stereotype would be, for the boomers at least, tell me where the Dow is and move on with life. In London, there's a much more nuanced view about macro and China specifically. James, what's the view on China right now in the city?
Yeah, I mean, I think people are nervous/cautious, but to be honest, as is often the case, you know, most folks are biased to believe that we will see what we have seen, and that is when China has a bit of a wobble, we should just expect quote-unquote stimulus, and that'll lead to a positive reaction from markets. So it's not something that people are really kind of looking to play as a macro theme, and the door doesn't swing both ways. When the US sneezes, the world catches a cold. The US is a massive consumer with a huge current account deficit. China really is consuming domestically and exporting a lot, and so it's not the same linkage, but you are seeing, I think, places like Australia and Germany likely to struggle going forward. But most people, I think, want to buy dollar CNH as an expression of China concerns, maybe sell the Aussie dollar, but not much else.
So, James, with that in mind, are we thinking about it the wrong way round? Not how China influences the US, but how the US influences China, given what's happened with real rates and what could happen with the dollar going forward from here?
Yeah, to a very great degree. I mean, you can see the Chinese policymakers, the PBOC, really trying to offset this weakness in the yuan. I guess they're worried about a similar situation to 2015 emerging and capital flight and creating bigger stability problems for themselves. But they are fighting what looks to be a pretty losing battle because the US data is just holding up that much better than everywhere else. And so in spite of the market desperate to trade carry, to trade risk on, the US dollar really is just starting to generate a bit of upward momentum because I think we are in a US exceptionalism world, at least for now. And that does create problems globally. It does create problems for dollar borrowers. We know that.
So what are you doing right now, given the fact that some people are saying we're at an inflection point? Do you believe that? Are you shifting some of your allocations in response?
I mean, I've been saying that we're on the precipice of an inflection for quite some time, and sometimes you look really clever and sometimes you look really stupid. It's been that kind of environment. Bear, bull, flatter, steepener, we've had it all over the last 8 weeks. I do think Europe is starting to show its true colours. They've got structural weakness and cyclical headwinds now because of policy and the pandemic effects subsiding, so increase a bit of duration there. And I think the US yield curve, I think there's a good chance it can steepen both ways. I think it can bear steepen in a soft landing, it can bull steepen if the data disappoints. You know, I love an asymmetric position, so adding to steepening risk and actually been paying US 5-year, because that looks really low, and if we get a bear steepener, that should rocket higher. But beyond that, it's quite difficult. Still trying to cling on to the more medium-term positions, generally being defensive, and hoping that the forward-looking indicators will give us an accurate indication, and that suggests things will get worse from here.
You mentioned a short squeeze. How much have the shorts been squeezed out? How much are people really long this equity market at a time where there are some real questions?
I mean, it's always difficult to say with any degree of accuracy, but if you look at surveys, if you look at sort of FMS, Hartnett's flow show type stuff from BAML, and you look at various other indicators and surveys that we would look at, it does suggest that there has been a shift. Sentiment has shifted away from expecting a recession, actually, to the majority of people not, from people being underweight or short equities in decent size to people being neutral to long. I think from a quantitative perspective, the CTAs, the vol control, the risk parity, these guys have not only been buying on rising prices, but they've been adding gross risk because of falling implied volatility. So I do think we're getting to that stage where most folk are now on the other side of the boat. That suggests it should take less to tip us over.
I love the flow show note. Michael Hartnett.
I do too.
At BFA. It's one of my favourites. And on Friday. James, thank you. Love the new dress code over at Aberdeen as well. James Athy there of Aberdeen over in London. I couldn't let that go. He looked so sharp today.
Good.
I thought he looked really sharp in the shirt.
Good.
Without a tie and no jacket.
Be clear that you're not being sarcastic. Just confirm.
There is most definitely a night out tonight in London for the team at Aberdeen.
You
I'm just
can't
going to
let
say,
him go.
Without a
you
doubt.
You cannot let him go and then spread rumours about,
That is not a rumour. Without a
You're
doubt.
going to say, okay.
There is a Thursday night out in the city because you take off Fridays now.
Right.
That's
you
work
what
from
happens. Yeah.
home.
Although even Tuesdays now are a
Tuesday.
night out.
Is Tuesday the night out?
Tuesday, Wednesday, Thursday.
Just the whole week.
Yeah.
Like, but don't come in on Friday.
Businesses are trying to rearrange restaurants.
Right.
Come in Tuesday. It's going to be good.
Tuesday nights are a thing.
Yeah.
You making that up?
Wednesday. I'm not making that up. I'll send you.
Who's going out
evidence.
Tuesdays? I don't believe you. Jobless claims coming up next. Matt Lazzetti of Deutsche Bank. Neither do I,
be
really.
honest.
The only one with a social life is TK. Matt Lazzetti of Deutsche Bank up next from New York. This is Bloomberg. It was bustling on a recent night at Avra on the 60th Street and Madison Avenue. Mm-hmm. Tuesday's a new Friday, New York Post.
See, there
Didn't
you go.
know. I was in Avra yesterday.
Yeah.
It was bustling at lunchtime.
At lunchtime.
Always is. Jobless claims, just around the corner, seconds away. Equity futures on the S&P 500, positive here by 0.25% going into that print. Yields are higher by 3 basis points. Your 10-year, 4.28. The jobless claims number looks a little something like this. 240 was the estimate. 248 was the previous number. And I'm waiting for the number to drop across the Bloomberg.
And you're doing a great job, by the way.
A little while. I'm just going to tap dance
Yeah,
a little bit longer,
The tap
Brammo.
dancing
Work
was
with
really
me.
good.
Jobless claims historically are at really, really low levels. Even at 240, it's been phenomenal. And it speaks to the fact that this labour market is still tight, with unemployment at 3.5%, even as job openings come down, Lisa, we haven't seen the pain in jobless claims.
Some people saying it's labor hoarding. Some people saying it's just supply and demand. We are getting some figures, so if you want to take a look at them, but it looks like we're not necessarily seeing any massive tick up.
239, it's as you were. The estimate, congratulations, Wall Street, 240. The number comes in at 239. The previous number, 248. I'll wait to see if we get a revision. Off the back of that in the equity market, not much price action for you. Still positive by 0.25% on the S&P 500. Yields are higher still on a 10-year by 4 basis points, 429 on a 30-year higher by 5 basis points at about 4.40. Coming up on the open in the next hour, Eric Knudsen of Neuberger Berman, Megan Swiber of Bank of America, Anastasia Amoroso of iCapital, and we'll catch up with Mr. Oliver Chen about retail, Lisa. All of that still to come in the next hour on Bloomberg TV.
Ask Oliver what you should wear next time we have a Tuesday night outing for the team. We're going to go out. Tuesday's going to be the new Friday.
He's so much sharper than I am.
And we're going to go out at,
I don't think I could wear the
3 p.m.
Oliver Chen look.
Yeah, well, anyway,
The
I'm
dude is sharp.
curious. Well, thank you. And I am curious to see whether Tuesday will continue to be the new Friday when they call everybody back to work, which seems to be something that's happening. We've been asking a lot of questions around how long the retailer can keep going, how long the consumer can keep spending, whether they're running out of cash, whether they're going to be challenged by some of their student loan payments. Matt Lazzetti has been upgrading his expectation for growth in the U.S. He has been spot on, pushing out his recession call. Chief U.S. economist at Deutsche Bank, joining us here in the studio. Matt, just first read on what we've seen in terms of retailers, the strength, the labor market not cracking. Is this an economy that can subsist with rates where they are for a very long time?
Look, I think right now it looks like the answer is yes in the near term. We just upgraded our Q3 growth forecast to above 3%. You know, everybody was anticipating, I think including the Fed, as we saw in the minutes yesterday, that you would see this second half of the year growth slowdown, that you're beginning to see rates bite, that the tightening of financial conditions and bank lending conditions was going to be impacting the economy. What it looks like we've seen with the data so far, now it's only a very little bit of data for Q3, is an acceleration. For the consumer, for industrial production. It goes against certainly what we were anticipating at this point in time and raises really important questions, I think, for the Fed.
One of the questions, and John asked it earlier, are rates restrictive currently? How do we even know if they are restrictive?
Yeah, I think the way that we typically view that is, you know, either through real rates, the Fed leans very heavily on real rates. And there we are seeing very significant increases in that, you know, 10-year real yields at many-year highs. I look at, if you look 5-year real OIS, so a measure of what our star type estimates are. All of these things have been rising pretty substantially. But then when you translate it into financial conditions, it's not obvious that things are too tight. Most financial conditions indices are loose, have been loosening. The one area where there is tightness is bank lending conditions, but we haven't seen that impact the economy as of yet.
So just taking a step back for a second before we get into the nitty gritty, and I ask you about student loan repayments and all sorts of other issues that are capturing people's attentions. There is a question of whether this is long and variable lags or if this is companies that have pushed out the maturities, consumers that have pushed out their maturities, and a lot of resilience at a time where consumers keep spending. Is this an economy that can keep humming along even if the 10-year rate continues to go up, even if we see 4.3% on a sustainable basis?
Yeah, so our baseline is no. You know, we still have this mild recession in the forecast, that we still think the bank lending condition tightening that we've seen, the real rates that we've seen, some of the headwinds for the consumers that are coming up, the student debt payments, the slowing labor market. You're seeing rising delinquencies within the consumer for both credit cards and autos. And so our baseline is no, that, you know, this is an acceleration, but it'll be short term. Eventually, you'll see monetary policy tightening take hold. But on the other side, you know, we're being surprised by the data here. And when you look at the incoming data for the labor market, obviously initial jobless claims not showing any uptick, any softening there. What you're seeing in the retail sales report is broad-based. Consumer confidence is picking up a little bit. So there are, you know, some elements there which make you a little bit more cautious or in terms of thinking about that slowdown in the economy.
What do you have to see to change your view?
So I think, you know, to go fully towards a soft landing, and I think we've been noting the prospects have been rising here, you need a few things. I think you actually do need to see the economy slow. And the reason that you need to see the economy slow is because the Fed has been very adamant that if it doesn't, they think that they have more work to do and that they can't have confidence that inflation is going to come down to target. We heard that from Powell at the July FOMC meeting. I thought we heard it, and that was the big takeaway from yesterday, that they need to see a slowing economy in order to get confidence that inflation is coming down. So I think you need that. You need to see wage and price pressures coming off. We're seeing some evidence of that. The last two inflation reports from CPI have been very supportive. The PCE report next week will be a little bit less so. But I think that's what you need. We're not getting that evidence on the growth front as of yet. And so I would anticipate from Powell probably next week, Jackson Hole, from the Fed, that they lean into a hawkish bias still, that the September SEP probably still shows some idea of rate hikes in the profile. And then more importantly, that they will probably hold that for even longer than anticipated.
Let's talk about some of the potential drivers for weakness that might take hold next year. It's what everyone's been expecting, and they've been saying this for quite a while. So we'll put that as a caveat. Student loan repayments. This has been a hotly debated topic, with some people coming out and saying, well, if students don't want to pay or former students don't want to pay, they don't have to. They're not going to be penalized for 12 months. And other people saying, well, they're going to try and they're going to have to pay back. Eventually, it will crimp their discretionary spending. Where do you fall on this?
Yeah, so we've thought there's going to be this meaningful headwind to the consumer. If you look at student debt payments in the daily Treasury account, they're down about $70 billion relative to where we thought they would have been. So that's a meaningful hit to consumer income if it gets paid in full. There's been certainly programs there that are trying to alleviate some of the pressure on consumers in terms of paying that over the next year or so. But we can track it on a daily basis. And if you look at the Treasury daily account, you are seeing a meaningful uptick in payments taking place. So people are paying down their student debt that were not doing so previously. But my guess is that the impact is going to be less than anticipated, or less than it was previously, simply because there are these programs that are trying to take away some of the pain.
We're speaking with Matt Lazzetti, chief U.S. economist over at Deutsche Bank, at a time where we're seeing strength pretty much across the board. We got reports out of retailers, including Walmart, Tapestry, Target yesterday, all of them showing strength in the consumer spending. Are you seeing any evidence that people are wholesale pulling back or not able to spend with such profligacy of the recent past?
Yeah, I think some things that you would point to are not primary but kind of secondary. So there's evidence that excess savings have been drawn down. The San Francisco Fed put out a piece just this week saying that it'll be gone in Q3, the current quarter.
We've been talking about this forever, haven't we? We've been saying it's going to run out, and it never does.
So that part, our view was always at the back half of this year, at the end of this year. And so I think that part is coming to fruition. I think you're seeing the evidence of that through, you saw rising credit card borrowing. You're seeing rising delinquencies. Those are now higher for autos and credit cards than they were before the pandemic. And so there are some strains there. Now, obviously, so far, that has not translated into retail sales data. It hasn't translated into the high-frequency credit card spending data that we've seen. And so far, there's not evidence of that. Obviously, the big question is, can that continue to run even as you have credit card debt picking up, you have delinquencies rising, strains are there, excess savings come down, student debt payments come back? Again, our baseline is that it can't run forever and that you'll see a slowdown that takes place, but the data have surprised the upside.
Everything that we're talking about almost presumes American exceptionalism, that the U.S. economy can remain divorced from everything else that's been going on elsewhere. And I think about China, and every morning we come in and we open with China and we discuss everything that's happened and the weakening there. When you look at the connections between the world's two biggest economies, how divorced is the U.S. from catching a cold from what China seems to be experiencing right now?
Yeah, I view it maybe through two channels. I think directly economically, as we look at the U.S. economy today, I think it is primarily domestically driven. It's about the services economy. It's about the U.S. consumer. And whether or not, Chinese consumers is strong in that environment is less relevant. So that direct economic impact to the U.S., I think, is probably more muted. Where I think it can have important linkages is through financial markets. And I think, some of the risk aversion that we're seeing is certainly being driven by what we're hearing in the daily headlines that you get out of China. If it is to impact the U.S. economy more significantly, I think it has to be through financial markets that you get turmoil that takes place there. And I think it's an interesting question. We talk about, high real yields, high yields maybe not impacting the U.S. consumer as much, but perhaps where we're seeing it is more on the global sphere, and that's where it's beginning to bite, and maybe there will be spillovers, but through financial markets.
And this is a reason why people are wondering whether things are getting close to a breaking point at a time where the fundamental economy seems to be doing just fine. How closely do you watch that? The financial transmission mechanisms, the surveys that come out, but also just some of the fissures happening on the global market sphere?
Oh, I think you have to follow financial conditions, however you might define them, very, very closely. I think we always, part of the reason that we anticipate, or people are anticipating we can get the soft landing, is because you're getting the economic data take place. You're getting a Fed that was hawkish and raised rates very substantially, but financial conditions have not fallen apart. I think if you see equities come down, credit spreads widen, the VIX come up, financial conditions tighten in a sharp and aggressive way, that often leads to very quick changes in narratives. And so if you get that taking place for whatever the reason might be, I think you'll see kind of a downgrade of soft landing prospects.
What do you think people are getting most wrong right now?
It's a difficult environment. If the economy is actually accelerating, then that is certainly, I think, one that is getting wrong. On our baseline, we still think that you have a recession. That is not the prevailing narrative in the market right now, even if it's the baseline for most economists. So I think if you get that, the correction in markets that we would need to see would be pretty substantial. The extent of Fed rate cuts next year would be far more substantial than what the market is pricing.
Matt Lazzetti, Chief U.S. Economist, joining us here over at Deutsche Bank. There is a question about whether markets can consistently see yields rising to this degree, the highest going back to 2008 for the 10-year yield, the highest going back to 2011 for the 30-year yield, without some sort of ramifications for risk assets. Right now, we're still seeing risk assets hang in there, eking out just a bit of gains after 2 consecutive days of losses. And this is what we're really watching. Can it continue? Well, what we have seen this morning is it has built. We have seen the S&P up 0.3%. And if you are just joining us now, we could see even crude levels coming up, $80.25 gaining despite some of the concerns over in China. S&P futures 44.33. Matt Lazzetti, the real question that I have from your seat over at Deutsche Bank is the work from home thing. I'm sorry, I don't mean to put you on the spot, but we were talking about Tuesday as the new Friday. And I keep hearing more and more offices, the obituary was written prematurely. How much are you hearing everyone coming back and the economies that kind of were around those offices also coming back?
Yeah, I think, for us at Deutsche Bank, we've been back in the office for a while here. As research, we have a little bit more flexibility, which is nice, I think. But we have a nice brand new office on Columbus Circle, so that's been a pull for us.
Deutsche Bank
the Deutsche Bank Center, as we often talk about here.
Do you call it that?
Of course I do.
Really?
Of course.
Yeah. So do you correct your family members when they say the Time Warner Center?
My family members don't talk very much about
they don't talk about it. They try not to bring it up. You know that you have a difficult thing about it.
Exactly. But no, I think, in certain areas, there will be a pullback to the office that takes place. And I think that there'll be positive benefits to cities as a result of that. There's going to be some elements of it that I think are more structural. So I think, once that happens, you'll have companies that are competing for workers in what is still a pretty tight labor market. And one of the benefits that they can provide is going to be that work from home environment.
Are Tuesdays the new Fridays?
I don't know about Tuesdays.
Thursdays?
Maybe Thursdays, although I'm not dressed for
Thursday, for going out.
Exactly.
You're not dressed like how they do in Aberdeen. Matt Lazzetti, of course. Thank you so much for being with us.
Thank you.
We really appreciate it. Coming up, we'll dive further into the retail sales, and we'll also dive further into what's going on with China. Coming up, Lupin Raman of PIMCO to talk about what the transmission mechanisms are, perhaps not necessarily even in the U.S., but Southeast Asia, the economies of which had done really well to this point. This is Bloomberg.
Heaven forbid we have a replay of 22, and inflation surprises to the upside on an ongoing basis, and central banks turn more hawkish. That would be pretty bad news for our strategy, for positioning in general, markets in general. And unfortunately, we are sort of seeing signs of reviving inflation in commodity markets, labour markets staying strong. Even falling inflation itself can bring about its own demise.
That was Ben Gooderidge, investment director at Invesco Solutions, trying to game out how this is going to work in a time of great confusion, trying to make sense of yields at the highest levels going back decades, or at least more than a decade. You're looking at a dollar that was strengthening, at least until today, at the highest levels since the end of May. If you look at the Bloomberg Dollar Index, you're looking more broadly at this sense that U.S. equities can rally even in the face of weakness in places like China, even Europe feeling more of the Chinese weakness, the U.S. remaining in an exceptional position, at least for now. Crude. If we get that slowdown in China, why is crude continuing to rally north of $80 a barrel? It had softened a little bit, but inventories are clearly tight. You're seeing them drawn down, and that has been affecting the price. China very much in the focus. And John asked a question earlier where he was saying, how much is this a China issue? And how much are some of the questions around the currency and around financial markets really a matter of the U.S. dollar and the U.S. strength and the U.S. rates picture, kind of creating some issues for the developing world and China in particular. Joining us now to parse through some of these concerns, some of these dissonances, Lupin Rotman, head of EM, Sovereign Credit and Portfolio Manager at PIMCO. I'd love to start there, Lupin. How concerned are you, as someone who focuses on the developing world, about a stronger dollar?
So the stronger dollar is an effect for emerging markets, which can be quite negative. But I think this time around, there are good reasons to think that, emerging markets are going to be a bit more sheltered than before. One of the key factors is what's driving the dollar strength. And part of that is this soft landing narrative in the US. So markets and the real economy that is a lot stronger than people had originally expected. And I think for emerging markets, that is really playing out in terms of where the growth outlook for EM is. It is slightly softer given the drag that we're seeing from China, but the strength from the US is keeping many EMs, particularly in LATAM, buoyed and growing stronger than they had expected.
So we'll get to that in a minute. I do want to touch on China, though, because that's kind of the elephant in the room, particularly for Southeast Asia. Mm-hmm. And it seems as though whatever message the Chinese Communist Party wants to put out there, the economy is struggling to perform, even with the expectations that have already been brought in. How much does it have a bleed-through effect that was unanticipated to the entire region and the debt and equities therein?
So I think China struggling is a concern, given that we are in a multipolar world right now. What is slightly different about this cycle is that it was expected to be a lot more services driven, so a lot more internally focused than being driven by the manufacturing cycle, which would have the larger impact for the rest of EM and East Asia in particular. I think that what is different now is we're seeing the PPI deflation, and that can have an impact on prices going forward for EM in a positive sense, really continuing some of that disinflationary trend. But I do think that having a China that is weakening more than expected without government authorities really having a all-in type of narrative is quite negative for EM sentiment.
So let's just pick through some of these ideas, because you're saying that disinflation or deflation in China might be positive. It might allow for disinflation or deflation in other nearby regions. Are you saying that on the margins, it may be more of a positive than a negative for some of these nations?
I think that on the margin, it can be a positive factor in terms of really allowing that disinflation process to ride through for the rest of emerging markets. And essentially, EMs are in a kind of Goldilocks type of scenario where growth is still reasonably positive. They're not in deep recessions, but you're still seeing this immaculate disinflation, if you want to call it, where headline and core inflation is coming down. And that's really allowing EM central banks to ease well ahead of the Fed.
Where does the strength come from, though? And this is, coming at a time where we do see signs of weakness in Europe. We do see signs of weakness in a pretty significant way from China. And yet the U.S. has technology. It has the fact that U.S. consumers love to spend and travel, et cetera, et cetera. Where does the strength outside of the U.S. come from?
A lot of the strength comes from some of the reforms that emerging markets have really undertaken throughout the last couple of years. So many emerging markets have focused on trying to get their fiscal house in order. The COVID shock was a big shock, which meant that many countries had to really tighten their belts and really see where further structural reforms on the fiscal side, whether it's revenue mobilization or expenditure controls, can take place. And we can see that in a country like Mexico, which really has a very tight fiscal, but is growing extremely well, given the policies that it implemented over the last couple of years.
So you've mentioned Latin America several times, and you think that that is an area that has unappreciated benefits that have not yet been priced in from the U.S. strength, from the proximity, from some of this disinflation. Where specifically, at a time where we're focused on some of the headline risk in places like Ecuador, Argentina, the mass devaluation, where are you seeing the opposite story?
So I think that, each country is very idiosyncratic. So, one of the countries where you are seeing positive developments is a country like Brazil, where you are seeing a central bank that is able to cut and is able to really take its path through the disinflation process with an economy that's still relatively strong and a political dynamic which is much more stable than it has been in the recent past. So those are some of the countries that are looking to be on a much more positive trajectory than in the past.
How concerned are you, just in a broader sense, of tourist flows, of people who kind of dabbled in emerging markets in the, FOMO era that was 2 months ago, and now might be rethinking that in an era of American exceptionalism, evidently, which may last, another 3 days. But my point is, how much are there fast flows that are going in and out of emerging markets that make it very difficult if you're looking in the short term at making some sort of tactical bet?
So I think the technicals in EM are extremely clean. So we've had such a large outflow last year when we saw the Fed hikes that this year, really, the technicals have been a lot cleaner than going into other cycles. So that really limits some of the fast money flows that you're speaking of. So from that perspective, I'm less concerned. What we are seeing in some EMs are institutional clients looking to take advantage of the cheapness and the sell-off and really increase their structural allocations.
What kind of yields do you need to go into some of these countries at a time where you can get 4.3% on a 10-year treasury?
I think that's a fair point. And I think that it's not only just a matter of yield, but really your expected return once you adjust it for volatility over the longer term. I think emerging markets have a role to play in global portfolios, which is quite distinct from the old EM story. And that is a risk diversifier, particularly in investment grade emerging markets. So these are emerging markets that have solid balance sheets, are doing the right things from a macro policy framework perspective, and they're offering you excess yield over US Treasuries or bonds. And those are the countries that we like to focus on.
From an EM perspective, what are you listening for next week at Jackson Hole? How closely will you be listening to how Fed Chair Powell guides?
I think the key factor will be to what extent the US economy is going to continue to be data dependent in terms of the Fed cycle, or whether there is an extent to which there may be concerns about the hard landing scenario coming back into question.
What does data dependent mean? And we ask this all the time because you can focus on any data and craft whatever story you want. What does it mean for you to be truly data dependent?
I think it really means on how the inflation trajectory is going to develop in the US as well as the labor market. We have seen reasonable strength in the labor market, but also some signs that there is slack emerging. So I think continuation of both of those trends are going to be what's important for the US.
Lupin Raman of PIMCO, thank you so much for being with us. At a really tumultuous moment, really, especially having to do with bonds. We're looking at bond yields that have just been surging, 30-year yields climbing through the highest levels that we've seen since 2011. Currently, they are continuing 4.4% off some of the recent highs. You saw the 10-year yield climb to the highest level going back to 2008, and we're looking at real yields driving the move. The real yield on the 10-year, adjusted for inflation, at the highest level going back to 2009. Coming up on Bloomberg TV at 2 p.m. Eastern, Tapestry CEO on the company's earnings and maybe some recent acquisitions as well. Right now, the S&P just managing to keep its head above water despite some of the concerns around the yield space, up 0.4%. The euro gaining versus the dollar, a bit of a dollar reprieve after several days of strength, and that 10-year yield, 4.28%. This is Bloomberg.